Okay, 45 people in so far.
Let me know when we're good to go.
Well, so far we're up to 55 people, or 52.
Yeah.
So I'm going to mute myself in case people will start calling.
Okay. Okay, should we start?
I think so. Let's just do a welcome and people will carry on joining.
Okay, so welcome to this, the second of our Zoom webinars, seminars, whatever what you want to call them, Zoominars. And we're privileged to have today the ever popular and erudite Professor Jackie Arendse. And just not to get into too much of an introduction, but Jackie, this now is the winter of our discontent. Can we look forward to a glorious summer?
Oh,
Okay.
well, I'm not a weather forecaster, so I'll stay out of that one.
Okay, so let's go to get the good news or the bad news, and the floor's yours.
Great, thanks very much. Thank you, Stan, and good afternoon, everybody. I must say, it actually is with a feeling of a fair amount of optimism that we are able to review this year's budget speech. I think some of us were a little nervous about what was going to emanate from the budget speech, and I think we all agree that from what we've seen so far, it's not all bad news, and there's certainly quite a lot of some good news items in there. There's also some bad news items that I will highlight, and some of them weren't actually highlighted at the time of the budget speech, but these are always things that tend to come out a little bit later on. So what we're going to be looking at today is just the sort of the highlights, lowlights, if you like, of the budget speech. So what were the main tax proposals? I've summarized some of them on this slide here. We'll be talking in some of these items in a lot more detail, like the Annexure C amendments, but I don't want to get ahead of myself. So let me start off by just highlighting the main aspects that came out of the budget speech. Of course, you know that the personal tax tables and rebates received adjustment. I think there were a lot of forecasters who were anticipating that this would not happen, that they would, it has been done in the past where this has been a way of obtaining additional tax revenue by not making these inflationary adjustments to the tax tables, and then we allow bracket creep and inflation to do its business by creating additional tax revenue. Well, this year I think it came as a pleasant surprise that actually the tax tables and rebates were adjusted. I think not surprisingly, the VAT rate stays at 15%. I'll talk a little bit more about some comparisons around the VAT rate just now. The company tax rate stays at 28% for now, with a promised 1% reduction to take effect in a year's time, going through to the following year end. Then trust, estate duty, donations tax, that all stays unchanged. The venture capital company, also something that attracted quite a lot of discussion over the last couple of years, actually, as it's attracted more and more attention. There was a lot of discussion around whether that sunset date should be extended. At the end of the day, it was decided not to extend it. So that's the demise of the VCC incentive. Transfer duty, unchanged. Fuel taxes increased, sin taxes increased. These are always perennial favorites to generate additional tax revenue. Environmental tax, also something that is attracting more and more attention internationally as governments, spurred on by the commitments that they make around climate change, etc. And they see that they sort of round that off with climate change taxes, carbon taxes, and other kinds of environmental taxes. And so we've seen some amendments coming through there, not across all of the taxes, but we'll go into this in more detail. And then, of course, on the technical side, and what will eventually translate into the amendments coming through in the Taxation Laws Amendment Bill, the draft bill, then the actual bill, and then eventually the Act. And these are the amendments that are listed in Annexure C. Okay, so we'll talk about these in more detail over the course of this webinar. So starting now, we'll go for about an hour and a half until about 2:30, and then take a break, a little bit of a leg stretch, tea break, and then we will go through, and the plan is to finish around about 4 o'clock. Okay, so yeah, I'm just going to go through all of the different amendments. I know some of them are common knowledge now, but just to make sure that we don't leave anything out, we will go through them and basically try and cover what was in the budget speech as far as tax proposals are concerned, try and cover that in as comprehensive a way as possible. Now, of course, as always, you are welcome to ask questions. We do try and make these webinars as interactive as possible. It is a little difficult when, of course, you are there and I'm here and you are looking at your screen, I'm looking at mine, but we do have this wonderful thing called the Q&A box, or you can even just use the chat function, and you can just pop your question in there. If you want to actually ask a question, well, I guess you'd have to ask Danny if he can unmute you, but it'll probably be easiest if you just type your question into the Q&A box or into the chat box, and then I'll take those questions. If possible, take them as you go along. Otherwise, certainly after the tea break, I'll spend a little bit of time addressing questions that have come in, and then at the end of the webinar, also take 15 or 20 minutes, however long is necessary, to address any of the other questions. Okay, all right. So let's have a look. Now, of course, I'm just talking about the revenue and the tax collection side of the budget here. So I'm not going to go into a whole discussion around the actual budget deficit, revenue versus expenditure. I'm not even going to talk about government debt. We all know that that's there. We all know that that's escalating at a rather alarming rate. Well, Tito Mboweni did have hope as his theme of the budget speech, and we hope that they are able to abide by their goal of capping the government debt at a whopping 88.9% of GDP in a couple of years' time. That's still an extremely high level of debt, but we're not going to get into that whole discussion. What I want to focus on is the tax revenue side of the budget, and then, of course, linked to that are the tax proposals. Okay, if we look at the tax revenue over the last few years, it's just interesting to have a look at what has come out compared to budget. Now, I do say this with a caveat that even when we look at budget here, this column headed budget, it's not necessarily what was laid down in the original budget. Okay, for example, if we look at 2017-18 and we think, wow, that outcome is pretty close to budget. If we went back to the original budget that was set in the 2017 budget speech, it may not have been exactly this number, because this number actually gets amended when the medium-term budget speech happens sort of mid-term of each fiscal year. Okay, so it is kind of a flexed budget, as it were. And so when we look at the outcome compared to the flexed budget, this is the deviation. But we see that there was actually a healthy outcome compared to budget in the 2017-18 fiscal year. And since then, we've fallen short of budget in each successive year. And if we look at the current year that we're in right now, which is this 2020-2021 year, the year that's going to end at the end of March 2021, we see that the new projected revenue compared to the budget is something like 197 billion rand short of budget. Okay, obviously that's a massive number. That's a huge deficit in terms of, and this is not the budget deficit, this is the shortfall compared to the budgeted revenue. So yeah, a huge shortfall. The hope is that next year the shortfall won't be quite so bad. So up to the end of March 2022, we see a deviation of 133 billion, let's call it. Of course, that remains to be seen over this next year, how things go through to the end of March 2022. But we certainly are quite a way into this year that's going to end at the end of March 2021. And so it does seem very likely that this is going to be close to what the final shortfall will be compared to budget. And if you think about when this budget was set, even going back to this time last year, we know that there was already a huge budget deficit based on the budgeted revenue. Now that the outcome is so much short of what was budgeted, of course, that just means that the budget deficit is going to be that much higher, and it means that translates into government debt being that much higher. So it certainly is a little bit of a dismal picture. I mean, I will talk now about the impact of COVID on this. And we know that COVID has had a huge negative impact on the economy, not just COVID, but also the response to COVID in terms of shutting down big sections of the economy for extended periods of time. And of course, that caused havoc in the economy. And so we see this coming through in this shortfall of 197 billion rand. Even last year, our outcome was less than what was budgeted, to the tune of almost 60 billion rand. In the previous year, shortfall of about 10 billion rand. So what is this telling us? It's telling us that our tax collections are generally falling more and more short of what is budgeted every year. And is this a reflection of just shifting in the tax base? Is it a reflection of a loss of taxpayers or a loss of tax base? Or is it that our budget is just overly optimistic every year? I would venture, without going into a whole detailed analysis of this, that it's a bit of a combination of both. Now, if we look at this shortfall, this deviation of 197 billion rand just for this current year, it's interesting to see where that comes from. So we know our major sources of tax revenue are personal tax, company tax, and VAT. So what is the sort of performance in terms of these major revenue items? And I've shown you here, so just the sort of top 6 revenue collecting items. Well, I've linked dividends tax in with corporate tax, just to put the 2 there. And then I've shown you the budgeted revenue for the previous year up to the end of March 2020, budget versus sort of outcome. And then for the current year, budget versus the revised budget, what we now expect to see as an outcome. And if we look at personal income tax, we see that last year it was pretty close to budget. This year, it's 64 billion rand short of budget. If we look at corporate income tax, last year it was 5 billion rand short of budget. This year, in the tune of 41 billion rand short of budget. If we look at dividends tax, last year 1 billion rand short, this year 8 billion rand short. Value added tax last year actually a little bit over. The outcome actually ended up being more than the flexed or updated budget. So we ended up getting 2.5 billion rand more than what we anticipated. Not so this year. This year, we end up being 36 billion rand short of our projected revenue outcome. In terms of specific excise duties, we ended up pretty close to budget last year. This year, way short, to the tune of 24 billion rand. Of course, specific excise duties, remember that is the sin taxes on alcohol and cigarettes. And so this shortfall, if you look at it, we ended up collecting, or we project to collect, only about half of what we anticipated or what we budgeted at the beginning of the year. And so, of course, that's pretty much due to the alcohol and cigarette ban, and 2 bans on alcohol during the course of the year, which all but decimated that industry. But it's interesting, if you think about it, the ban on alcohol and cigarettes didn't last for as long as 6 months of the year. But we end up losing half of the total revenue. So it shows you that the ban on alcohol and cigarettes has had a kind of an exponential effect. It's not just the loss of specific excise duties on the sales that may have happened during the period of the ban, but this seems to have had a flow over effect, that actually there's been even more of a loss. Is it because people gave up smoking and drinking as a result of the ban? I don't think that's a massive contributor. I think maybe another part of this, and possibly this needs to be examined and researched, is that you may find that people's sources of where they're buying their products from shifted when those bans happened, and they ended up acquiring goods on the grey market, as it were. And maybe we've lost even more of our tax base because more people are now buying, let's say, cigarettes on the grey market and not paying the specific excise duties. As I say, it warrants further attention. It's a massive deviation to end up collecting only half of what we projected on specific excise duties. And if you think about it, even thinking about how much money it's going to cost to roll out the vaccine, and we think that we lost 24 billion rand in sin taxes during the year. It's really a tragedy to think that, you know, we now have to find this money elsewhere to pay for the vaccines, and yet we could have actually collected this money. It was there for the taking, as it were. Specific excise duties, we've seen in the past, they very seldom fall short of what is budgeted for, because even if you raise sin taxes, you don't see an equal and opposite reduction in consumption. So it is a pretty much guaranteed source of additional tax revenue. So to actually lose that tax revenue is quite a tragedy for our tax base. If we look at the fuel levy, also last year only about a 3.6 billion rand short of budget. This year 8.2 billion rand short of budget. Well, I guess a large part of that again linked to the impact of COVID and the fact that people weren't able to travel as much. Business travel was reduced, even deliveries and so on, in some respects may have lessened during some of the hard lockdown periods. And so, yeah, that sort of translates into that reduction or the shortfall of the fuel levy. So I think all across the board, remember that we said that our total tax revenue was 197 billion rand short of budget. This gives you the majority of that figure. It's not all of it. There's bits and pieces from elsewhere. I just didn't want to make the slide too dense with information, but it gives you the main generators of that shortfall. And actually, if you look at this across the board, the underlying common theme here is the impact of COVID-19 on our economy, and also the response to that in terms of shutting down the economy. And so we've seen that the negative impact on the economy, we've seen stats at our economy. There was a shrinkage of about 7% year on year over the last year. And so we see that coming through in these numbers. Even in the dividends tax, we saw that many companies slow down on paying out dividends, holding on to their cash. And we see this coming through and having this impact on the dividends tax. Now, of course, the picture was actually worse when the medium-term budget speech was presented in October last year. Much worse. In fact, so much worse that at that time, the Minister of Finance announced that they would have to raise additional tax revenue to the tune of extra 40 billion rand over the next few years in order to provide them with the additional tax revenue that they would need. Between then and when this budget speech was presented at the end of February, things actually improved unexpectedly. Well, of course, you know, we managed to see things improving for a time around COVID before we had the second wave. And then now, of course, we seem to be coming out of that second wave. But there was also a little bit of a mini commodities boom. And actually, the mining companies especially ended up showing profits a lot better than what was originally anticipated. Plus, the impact on some areas of the economy was perhaps not as bad as they thought it was going to be in October last year. And so the one bit of good news that came out of the budget speech, the minister announced that they would not in fact need this additional 40 billion rand in tax revenue because they have managed to generate this additional 100 billion rand as a result of these various factors, 100 billion rand more than what they thought they were going to get in October last year. So at least there was a little bit of positivity there, that it did mean that instead of us looking at inevitable hikes in tax rates, possible, you know, wealth taxes and things like that, having to be introduced, special tax to raise money for the vaccines and so on, we ended up with the much better news of saying, actually, for the time being, we can manage without having these massive additional tax increases. And so what we see coming through there is basically that, yes, we are still way short of budget. It's not as if things are now fantastic and we can all, you know, just forget about the problems that we have. We still have big government budget deficits. We have ever increasing government debt, and these things are still going to require very careful management over the years ahead. But I think for the time being, we all heaved a huge sigh of relief that we were able to at least maintain things as they are without seeing big tax increases at this stage. Now, what I just thought would be interesting, people often ask, you know, out of this personal income tax, corporate income tax, how much do we generate by way of capital gains tax? Of course, capital gains tax is not a separate tax. It's a tax that we recover through the income tax system. Now, in the SARS statistics that they released a little while ago, the 2020 statistics, they give a breakdown of the capital gains tax that is raised by way of personal income tax and company income tax year on year. And so we see that there is a bit that is raised. And so these numbers are obviously included in these revenue numbers over here. So if I say personal income tax in the current year, let's go back to 2020, raised to the tune of 528 billion rand. Out of that, capital gains tax contributed 6 billion rand. So it's a very small amount of our total income tax collections. In fact, it really, if we had to rank this with the other taxes, capital gains tax, let's say 6 or 7 billion, 6 billion for individuals, 7 or 8 billion rand for companies in 2020. Well, you know, that's way less than any of these other way of things like smaller taxes. It's a bit more than that. Generator. That's enough. Some attention to be given. There were no amendments that were made. Capital gains tax, and when you look at tax and we think how complicated to see SARS really on capital gains tax. I think when we see fixed transactions, we're going to start between perhaps what people are reporting the legislation. So I still think it's an area of how much tax is generated compared to the complexity. One has to wonder whether it's the wisest way of raising revenue. But having said that, capital gains tax is not going to go away anytime soon. It's just a kind of a theoretical thought given there as to whether, this amount of revenue justifies the complexity and the time taken to maintain the records and the reporting and so on that has to happen for capital gains tax purposes. Okay, so that was just the other comparison that I wanted to show you around how much we generate by way of capital gains tax. Then let's just have a look, before I get into the detail of specific tax changes, what does our tax to GDP ratio look like compared to other countries? Now, this is based on the OECD measurement, so it's not necessarily the percentage that is reported in the budget documentation. So they show, this is also from 2017, so, it's a couple of years ago, but OECD, interestingly, does generally report the tax to GDP ratio a little bit higher than what is reported in the budget documentation. The budget documentation reports this as being in the region of about 26-27%. OECD measures it at 28.4%. Be that as it may, let's compare that to our other countries. OECD average, now we are not a member of the OECD. OECD generally comprises the more industrialized countries. There are 36 member countries of the OECD. South Africa is not a member country, but we do have observer status. And so that's why we tend to attend all their meetings. We have representatives there. And we obviously follow the OECD guidelines on many different tax matters, especially in the area of international tax. So the OECD countries on average, their tax to GDP ratio is high, 34%. But remember that they have social security taxes. In our cases, we don't count that as a tax because our pension contributions is something separate to that. We don't have social security tax as such. So that tends to boost their tax to GDP ratio. If we come down to our tax to GDP ratio at 28.4%, amongst all the African countries that are measured by the OECD, and now they're not member countries, but the OECD does gather statistics on these African countries, we are the third highest. So Seychelles is the highest, then Tunisia, then South Africa, and then Morocco. So we are definitely way up there in terms of our tax to GDP ratios. And I think that I hardly need to mention this, that we are a highly taxed country. If we look at the average of Latin American countries, LAC, they're sitting at about 23% of GDP. And African countries on average, if we come down to this line over here, 17%. And we are sitting, as I say, even our own reporting puts us at about 26-27%, and the OECD puts us at about 28%. So we are much higher than the African average. So I think it's important to recognize this when there's discussion around increasing taxes, introducing additional taxes, and so on. We should not be needing to introduce additional taxes. We are already a highly taxed country. What we need to be doing is managing more carefully within the revenue that we are generating. Now, another interesting aspect when you look at the revenue that we are generating is the composition of that revenue. If you go down to the bottom of the slide here, South Africa, this is again based on OECD numbers. So our total tax revenue collections, as we know, most of that comes from personal income tax. This blue line on the left, you can see the legend over here, individual taxes, personal income tax contributes around about 35% of our total tax collection. The next biggest contributor is VAT. There's a slightly darker blue line over here, is VAT, and then corporate taxes. So those are our big three tax contributors, right? If we look at OECD countries, we see that their personal income tax contributes much less of the overall pie. In fact, most of their pie seems to come from social security taxes, which you could kind of link that into personal income tax, I guess. That then is the next biggest contributor, and then corporate tax. Corporate tax contributes a much smaller percentage of the overall pie compared to what we see in South Africa. And if we compare to other African countries, this third line down over here, I found this really interesting, is that if you look at other African countries, or the African average across all African countries, they tend to collect their biggest share of tax revenue comes by way of consumption taxes, value-added tax. And yet we are a little bit shy in terms of using that as the sort of primary source of tax revenue. We rather get our tax revenue from the personal income tax. And actually, if you look at it, remember that, we're getting our personal income tax from less than kind of 6 million taxpayers out of a population close to 60, sort of 55 million people. So we've got a huge reliance on a very small number of taxpayers, whereas other African countries tend to have their tax revenue much more spread across the whole population, relying much more heavily on consumption taxes, which really are borne across the population, a much lower reliance on personal income tax, and maybe a slightly higher reliance on corporate tax than what we see here in South Africa. So I find this very interesting in terms of looking at our tax revenue composition. It has been mentioned for a few years now that there seems to be a trend focusing more and more on consumption taxes and indirect taxes, as opposed to direct taxes like corporate tax and even personal income tax. And who knows, that might be a direction that South Africa would need to start looking at going ahead, because it does seem to be becoming increasingly risky to kind of place so much focus on just a few taxpayers in terms of our reliance on personal income tax to kind of bolster our tax revenue collections. Now, just focusing on VAT for a while, I mentioned that the VAT rate is not increasing. And I mentioned also that VAT in most African countries is the biggest kind of source of tax collections. And so you can see here this comparison over here with some numbers inserted, that for the African average, they look at collecting almost a third, 29% of their total tax collections comes in the form of VAT, higher than your Latin American countries, significantly higher than what we see across the OECD. And if we had to put South Africa in there, we get around 22% or so of our tax collections from VAT. So yeah, we are slightly more than the OECD, but certainly nowhere near the African average in terms of the reliance on VAT as the most important source of revenue collections. Now, it's also interesting that when you look at the reliance on VAT across other African countries, their average VAT rate is 16%. So this is across, I extracted the VAT rate for about 30 different African countries, and it ranged from a low of 10% to a high of 20%, with an average of 16%. If we look on the OECD countries, ranging from a low of 5%, that's in Canada, I think it was, which is quite interesting, up to a high of 27%. That's a really high VAT rate, with an average rate of 19%. And of course, we put South Africa in there with a VAT rate of 15%. So it really does show us that our VAT rate is low compared to other VAT rates internationally. African average, 16%, OECD average, 19%, and our VAT rate is 15%. But we know that politically, there is very little appetite for raising the VAT rate. We saw that the government did approach this a few years ago. We raised the VAT rate from 14 to 15%, and there was so much fallout and pushback politically that many people in government said that they really don't want to go through that process again. So it seems that we're going to be staying with a VAT rate of 15% for the foreseeable future. But of course, we do need to understand then, if we are going to be cutting down on corporate income tax and we're going to keep the VAT rate the same, what it's really doing is just putting ever more reliance on personal income taxes. And of course, we all know that in terms of risk profile, the more you have reliance on kind of one client or one source of revenue, the more risky that becomes. And I think South Africa may have to look at kind of spreading our tax risk in a more healthy way in years to come. However, that would be a very long-term discussion. Right now, we're not looking at any specific changes in the structure of our tax system in South Africa. All right, so moving on to specific things over the last year. Of course, we know that we have the COVID-19 tax relief measures that came through the Disaster Management Tax Relief Act, promulgated in the latter half of 2020, and that the COVID-19 tax measures came in kind of a number of different ways. We saw the deferral of provisional tax, employees' tax, and specific excise duties. The manufacturers of alcohol, because normally they would pay their specific excise duties as the goods are manufactured, but because there was a delay due to the alcohol ban, government negotiated with them a deferral of the payment of the specific excise duties, the sin taxes on alcohol. So there were deferral mechanisms there. And what was announced in the budget speech is that these basically were higher than expected. There was cash flow relief that was provided to the tune of some 28 billion rand. Now, that's not total cash flow relief. It's a breathing space, whether it be on provisional tax or the deferral of specific excise duties. All it is deferring the payment of those taxes until a later period of time. So that payment still has to be made by those taxpayers, but it just gave them some breathing space. And so it was reported that there was a healthy take-up on those tax relief areas. There was also, of course, the deferral of PAYE that was available during the course of 2020. Here, the report was that the take-up was much less than was anticipated. Government had budgeted 19 billion, or they expected relief to the tune of around 19 billion rand deferral. So this is a kind of an interest-free loan from SARS, if you like, that you could defer the payment of the PAYE. Remember that there was a deferral, but then you'd have to spread that repayment over the 6-month period. And companies used only 1.9 billion of the projected 19 billion rand relief. So a much lower take-up on the PAYE deferral than what government expected. They have said that they are planning the additional 4 billion rand tax deferral for the alcohol industry, but that will be granted on the case-by-case applications. This is for the latest alcohol ban that took place and for the cash flow problems that were created as a result of that. Remember also that we did have the skills development exemption, levy exemption for a few months, and that provided relief of about 5.9 million rand in line with estimates. Interesting that, you know, the skills development levy exemption, the take-up there was in line with estimates, not so much with the PAYE deferral. I think a lot of employers just figured that they would rather just, if they were able to just pay the employees' tax, rather just pay it, with the thought that the deferral and then having to arrange for the payment over the remaining months might just become more complicated than was deemed expedient. Then, of course, there was also the TERS system and the expanded ETI system, and their companies could choose, and they claimed 57 billion rand from TERS against 1 billion rand from the expanded ETI. So a lot of take up on TERS. I'm sure a lot of tax practitioners were involved in assisting their clients with that. And so we see that there was quite a lot of take-up on these COVID-19 tax measures. I think they've all run their course now, except perhaps with the specific excise duties on the alcohol industry. Although it was mentioned, however, not taken up in the budget speech, but it was mentioned when they put the final amendment bills together last year, that they would look at further COVID-19 tax relief measures, but there hasn't been any further announcement around that. Okay, so let's then get into the actual announcements of the budget speech. I don't need to focus too much on the personal tax tables. I'm sure you're all aware of the fact that all of the thresholds have increased by 5%. So there is real tax relief there, because the inflation rate is only in the region of 4%. So yeah, an adjustment to the tax tables in excess of the rate of inflation. Also an adjustment to the personal rebates of 5%, or over 75s came in at 4.9%, almost 5%. So 5% adjustment to the rebates across the board. And of course, if you then put that all together, it means that our tax thresholds went up by 5%. So tax threshold is how much taxable income your taxpayers, your individual taxpayers can earn before they end up paying any tax at all. So under 65s can earn up to taxable income of up to 87,300. Over 65s, over 75s have a higher threshold because they have the higher rebates, obviously. Okay, so we see all of those increasing by 5%, which, as I say, is more than the inflation rate. Therefore, we see that there is real tax relief that has been given to personal taxpayers. And it was very heartening to hear the minister actually showing appreciation for taxpayers in South Africa and saying thank you to taxpayers who abide by their obligations and pay their tax on time. So heartening to hear that. Then, of course, on the company side, so our company tax rate has remained at 28% for many years now. And as the trend internationally has been for company tax rates to reduce, we see that our company tax rates more and more stands out as being high compared to other rates internationally, certainly amongst our trading partners. And so there's been more and more call on government to reduce the company tax rate. They have now announced that they will lower the company tax rate by 1%, but please note that this is only coming into effect for years of assessment commencing on or after 1 April 2022. So the first year end that will actually be affected by this lower tax rate will be the year ending 31 March 2023. So it's really only in 2 years' time. Okay, granted, it'll affect the provisional tax payments that take place during that year, but it's only going to take effect for the 2023 year end and thereafter. Okay, so it's something that's going to come in the future, and it's a proposal at this stage. Of course, it hasn't been legislated yet. Now, I've shown you the composition of our tax revenue and how we rely quite a lot on corporate tax as the third biggest contributor towards the overall tax revenue pie. And so government cannot just give up the tax that will be foregone by reducing the company tax rate by 1%. And so they've said that this will be done alongside measures to broaden the corporate tax base. And that will be done specifically by limiting interest deductions and the set-off of assessed losses. I should also mention that a big part of corporate tax also is looking at international tax, looking at things like transfer pricing, controlled foreign company legislation, and so on. And their government is certainly tightening up and working very closely with the recommendations of the OECD as they've been working through their whole exercise basically since 2013, looking at base erosion and profit shifting and how to minimize base erosion and introducing various measures related to that. And so that will also come in terms of expanding or protecting our corporate tax base. But the main measures to kind of broaden the corporate income tax base will be the limitation, the further limitation. We already have some limitations on interest deductions, but there'll be further limitations on interest deductions and also new limitations around the set-off of assessed losses. And so on the back of that, they announced that government will give consideration to further rate increases in future years to make our corporate tax system more attractive, but they will do that in a revenue neutral manner. So as they boost their tax collections through broadening the tax base, so they would be able to reduce the headline corporate tax rate. Okay, so that will be done taking into account the various recommendations of the Davis Tax Committee as well. Now, if we look at the limitation on the deduction of interest, we already have interest limitation provisions in the Income Tax Act, Section 23M, 23N. They are very specific. What was proposed in the 2020 budget speech was that there would be sort of enhanced measures to limit the deduction of interest. And they released a discussion document in sort of following on from the budget speech in 2020 with comments due by the 17th of April. Comments have been gathered on that. National Treasury started the process of putting together draft legislation, but that was then all delayed. It was originally going to come in for years of assessment commencing on or after 1 January 2021, but it was delayed because of COVID. And of course, SARS and National Treasury had to turn their attention to the COVID tax relief measures and the legislation that had to be released relating to that. So they deferred this limitation on the deduction of interest. Nonetheless, they have all these comments in the bag. They have worked through them. They'll be considering them. And what they initially had proposed in terms of their 2020 budget proposal was to cap their net interest expense deduction at 30% of EBITDA, earnings before interest, tax, depreciation, and amortization. In the tax context, that is taxable interest before taxable income before the deduction of interest and before the deduction of any capital allowances. So the idea is you work that out, and then whatever interest expense you want to deduct is capped at 30% of that. The idea is that this would apply to companies in multinational groups, and if interest exceeded the cap on the deduction, then the excess could be carried forward, but only up to 5 years. They did mention having a sub-minimum amount, could be anything as high as perhaps even 5 million rand would be allowed as a straight-off deduction, no limitations, but it's only for really material amounts of interest that you would see this limitation kicking in. So that was the one area on the limitation of interest. As I say, they started the process with their discussion document, and they have come out with some further ideas on that, and we can expect to see draft legislation later this year. In terms of the set-off of assessed losses, also announced in the 2020 budget speech that the set-off of assessed losses would be capped. Now, up until now in South Africa, we've not really had limitations on the set-off of assessed losses. We have ring fencing of assessed losses that happens on the one hand with your offshore trades, and then on the other hand through Section 20A, but that really only applies to your individuals who are in the maximum marginal tax bracket. So apart from that, we don't have any limitation. If you have an assessed loss, you can just continue setting that assessed loss off without any time restriction or any restriction on the kind of the amount of the assessed loss that you're setting off. If this recommendation that was announced in the budget speech last year sees the light of day, then their proposal is that they would cap the set-off of an assessed loss at 80% of taxable income. So if you had a 100 million rand assessed loss at the end of last year, and this year you have 50 million rand of taxable income, you wouldn't be able to set off that whole 100 million rand. You would only be able to set off up to 80% of the current taxable income. So 80% of 50 million, 40 million. So you would still end up with part of your current year's taxable income being taxed in the current year. Of course, if you're only able to set off 40 million rand, you've still got 60 million rand of assessed loss that would then carry over to the following year. And the idea is that you would be able to carry your assessed losses forward, but they are looking at introducing a time limit. Now, having a look at, again, international comparisons, many countries internationally have limitations either in terms of value or time, and sometimes both. We're considering perhaps both. Certainly many countries have either one or the other. Some countries have a time limit as little as 5 years. China apparently has a time limit of only 5 years. Some have other time limits that are longer than that, but they do have specific time limits. And others have limitations in terms of something similar to what we're looking at here, where we set a value on the limitation, like 80% of taxable income. So what we're doing, or what is proposing to be done here, is not completely unique or novel if we look at international comparisons. So these are the two proposals, and the idea from government is that these would significantly bolster the tax base on corporate income tax, and they are hoping to collect more corporate taxes as a result of these measures, coupled with, as I say, the tax-based protection measures that are coming through all the OECD developments. And the idea is that as they collect more corporate tax with those measures, then they would be able to reduce the corporate tax rate. Okay, so we can expect to see these amendments coming through during the course of this next year, the limitation on the deduction of interest and the limitation on the set-off of assessed losses. It would be expected that we would at least see another discussion document coming out, or perhaps draft legislation with the opportunity to comment. And these, of course, are very important amendments. It is expected that the real impact of these amendments would be on the large corporates, especially on the large multinational groups. Shouldn't really have that much effect on your smaller owner-managed companies, but it doesn't mean to say that owner-managed companies will be completely off the hook. We'll have to have a look and see what these specific proposals are in the draft legislation. So the statement in the 2021 budget speech was that they have postponed the introduction of these two measures until 2022. So remember, they were due to come in for years of assessment commencing on or after 1 January 21. And so the idea is that that will be pushed out by a year. And the expectation is that we will see a further discussion document or draft legislation. Following on from last year's discussion document, what they have said is that their proposal is to expand the scope of the current interest limitation rules. That'll be the limitation rules that exist in Section 23M and Section 23M, capital M, capital N. Okay, so those rules link around a limitation on 40% of EBITDA. So here they're looking at including similar interest items and to adjust the limitation to 30% of EBITDA. So reducing the cap, as it were, from where it is at the moment. And then also to restrict the interest that will be subject to this limitation to only connected person interest rather than all interest. So in some ways restricting the scope, but then in other ways limiting or making more severe the cap or the limitation on how much interest would be allowed to be deducted. So have a look for this in the next set of draft proposals, and especially I think also look out for the draft legislation around the set-off of assessed losses. Of course, with the company tax rate, if we look at a current company tax rate of 28% and a dividends tax rate of 20%, we talk about an effective tax rate of 42.4%. How we get to that is we would say a company that, let's say, has 100% of pre-tax profits, take off 28% company tax, we're left with 72 Rand available for distribution. If all of those dividends go to shareholders who are liable for dividends tax, i.e. individuals and trusts, and liable for dividends tax at the full rate of 20%, then the full tax rate on those dividends is an effective 14.4% on the original 100 Rand of pre-tax profits. And so that takes our effective tax rates on fully taxed distributed profits to 42.4%. Compare that to the maximum marginal tax rate on individuals of 45%. And if we see this company tax rate going down to 27% in the 22-23 tax year, of course, out of every 100 Rand of pre-tax profits, we would then have 73 Rand left available for distribution. If that was taxed at the current dividend tax rate, if it stays the same, I'm not sure what it's going to be 2 years down the line, but if it stays the same at 20%, then your effective tax rate on your dividends, if they are fully taxed, would be 14.6%. And that would take your effective tax rates on fully distributed and fully taxed profits to 41.6%. So even further off the marginal tax rate on individuals, which is currently at 45%. Now, it's quite interesting because for a long time, SARS especially has been quite fixated on this idea of trying to make sure there's no opportunity for tax arbitrage. So we don't want there to be a gap between these two rates, the 45% maximum marginal tax rate on individuals of 45% versus this effective tax rate on corporate profits, which could drop as low as 41.6%. So it remains to be seen whether the authorities are happy just to live with this gap between the two rates, or whether, for example, they would increase the dividend tax rate to try and reduce the gap. We don't know. The only thing that's been told to us at this stage is that we would see a reduction in the corporate tax rate. We haven't been told anything about what's going to happen to the dividends tax rate. And there certainly has been no mention of dropping the maximum marginal personal tax rate of 45%. So it would seem that we would just end up with this gap between the two rates. All right, let's move on to small business. Unfortunately, once again, we see basically no change to the tax table for small business corporations. Remember, these are companies that meet the definition of being a small business corporation, that definition in section 12 cap E subsection 4 of the Income Tax Act. If you meet the definition of a small business corporation in a particular year of assessment, then you'd be eligible to be taxed according to this preferential tax table. Obviously, this gives you a better outcome than being taxed at 28% from the first rand of taxable income. So here we see the taxable income up to 87,300. You would have a tax rate of 0%. So this rate of 87,300, this threshold, is always in line with the tax threshold for individuals under 65 years of age, which I showed you near the beginning of the presentation. So we saw that tax threshold increasing by 5% because of the change to the tables and the adjustment to the rebate. So as the personal threshold for people under the age of 65 went up to 87,300, immediately this tax table automatically changes to reflect the same threshold. Apart from that, everything else on this table stays the same. Obviously, with that threshold increasing from 83,100 to 87,300, it does flow through in terms of the amount of tax. For example, if you had taxable income above 550,000, and you start getting taxed at the 28% tax rate, but as 28% of taxable income above 550,000 plus that base amount of 58289, which according to the old table and the old threshold would have been 58583. So you're saving around about 300 Rand as a result of the adjustment to that threshold up to 87,300. So that benefit flows all the way through the table, but it's not really giving any significant benefit to small business corporations. It remains to be seen, going forward. There's a much bigger exercise underway looking at how to incentivize small businesses, what is actually needed, what is needed to encourage people to become entrepreneurs, and how to build businesses even in rural areas and so on. And so there's a much bigger exercise underway, which may well see this table being adjusted in years to come, but we've certainly seen no change to this table for quite a number of years now. And similarly, on turnover tax on micro businesses, this, as the name suggests, micro businesses, very tiny businesses with turnover not exceeding R1 million for the year. And we've seen no change to this table at all. Everything stays exactly the same. Okay, then moving on to other aspects relating to individuals now. Let's look at incentives for savings. Our local interest exemption, no change. Well, we don't expect there to be any change to this exemption in the foreseeable future. This harks back to the time when Pravin Gordhan was Minister of Finance in his first phase as Minister of Finance, when he introduced the tax-free savings concept. And the statement at that stage was that the idea was to move more towards utilizing the tax-free savings incentive and ultimately phase out this local interest exemption. So at that stage, the announcement was made, there'll be no further change to this exemption. So we don't expect any inflationary change or otherwise to this exemption in the foreseeable future. If we look at the tax-free investments, the current situation, which has been since the 1st of March 2020, is that individuals can invest a maximum of 36,000 Rand per year into a tax-free investment. That was initially 30,000, then increased to 33,000, and then of course went up to 36,000. We still have the lifetime limit of 500,000. So this is the amount that people are allowed to invest into a tax-free investment in any particular year. Remember that there's no tax benefit given for the amount that goes into a tax-free investment. There's no deduction or anything that happens as far as that's concerned. But what happens is with the return within that tax-free investment. So depending on what kind of investment you put your money into, you might just put that into a savings account. Well, you're not going to earn a lot of interest that way, but if you did that, what it means is that the interest would, any interest you earned on that account would be immediately tax-free. If you put your money into a more sophisticated product, an ETF or something like that, where you have possibly a return in the form of interest, maybe dividends, maybe capital gains tax, well, all of those returns are completely tax-free. And that's the idea with the tax-free investments. It's the returns that are tax-free. And there's no limitation on how much is tax-free. The limitation comes in how much you can invest into those products. Okay, so that's why we have this limitation of currently 36,000 Rand per year, lifetime limit of 500,000. So that's how much you can put into the products. Whatever you earn on those investments is 100% tax-free. And currently we have this tandem system where we have the tax-free investments together with the local interest exemption. As I say, further down the line at some stage, there may well be the decision to do away with this local interest exemption and rather just stay with the tax-free investments. And that's why it is a good idea, even though we're not talking about a lot of money every year, but the idea is that incrementally one should be putting this money into tax-free investments, let it just accumulate, because ultimately all of your returns would be entirely tax-free. So if we did then do away with this local interest exemption and you've then shifted your savings into tax-free investments, you're getting your tax benefit there. All right. Okay, so that's the idea with the tax-free investments. As I say, no further changes in this year's budget speech. If we look still on individuals, the other issue that people are always concerned about, well, this comes normally immediately after the tax tables, the rebate, and then, of course, what comes through the medical rebate, the medical credit. To be specific, the medical scheme fees tax credit that comes through Section 6, capital A. Now, this is a monthly credit that comes through if the taxpayer has contributed to a medical scheme. And the idea is that there's a monthly amount, because this can then be taken into account by the employer through the employee's tax system. So that monthly amount, you'll see there's a 4.1% increase, or for additional dependents, 4.2%. So that's an inflationary increase. It's not as much as the 5% increase we saw that was applied to the actual personal tax tables, but at least it is an inflationary increase that has happened to this monthly amount. So we see it going up to 332 per month, and this comes in, it has come in from the 1st of March, so it came in from yesterday. Okay, so for the member and the first dependent, 332 per person, and for each additional dependent, 224 Rand per person per month. Now, there are two medical credits, right? There's the Section 6A credit, and this can be taken into account by the employers every month for payroll tax purposes. And then we get the additional medical credit. The additional medical credit for people under the age of 65 is only taken into account on assessment. For people over the age of 65, the employers can take this into account for employees' tax purposes. There's no change to how this additional medical credit is calculated. Of course, there's different calculations depending on whether you're a taxpayer who has preferential treatment. That's in the block on the right. That talks about taxpayers who are 65 years and older, or the taxpayer spouse or child is a person with a disability. Then they get a preferred treatment. You'll see they get 33% of their qualifying medical expenses and excess contributions, and there's no hurdle rate. You don't subtract 7.5% of taxable income. Whereas for other taxpayers, those under the age of 65 who are not persons with a disability, there you're looking at 25% of your qualifying medical expenses and excess medical contributions. The excess medical contributions is the excess actual contributions paid minus 4 times medical credit, the 6A medical credit. All right, so you take if there's any excess plus your qualifying medical expenses actually paid out-of-pocket expenses paid by the individual, but then you have to subtract this hurdle of 7.5% of taxable income. Okay, so yeah, it does mean that the chances of getting this additional medical credit are quite slim for the average person, unless you have really out of the ordinary medical expenses that you have to pay out of your own pocket in a particular year. Okay, this question from Ian looks like it's dealing with corporate tax. I'll come to that after the tea break. Okay, so the additional medical credit, no change at this stage. Right, and then just on UIF, of course, UIF is paid, it's a payroll tax, 1% from the employer, 1% from the employee. The only change here is that from the 1st of March, we've seen this remuneration threshold increase to 17712. So it means that people from the 1st of March could be paying more UIF than what they did before, because instead of being capped at 148.72, it's capped at 177.12 from March 21 onwards. On the skills development levy, no change there. It's still 1% on payroll. But remember, there is this exemption if your annual remuneration of the employer does not exceed 500,000 Rand. Okay, then on to some specific changes that have come through that were announced. And this has come through in terms of the taxation laws, the draft Revenue Laws Amendment Bill. And in terms of the retirement annuity fund withdrawal, now just to put this into context, so this came through one of the notices that was published in the Government Gazette. So we've seen the draft notice that has been published at this stage, and it links to paragraph B10cc of the proviso to the definition of retirement annuity fund. So if you look it up, what this is actually referring to is remember that normally when you're a member of a retirement annuity fund, you put your money into the fund as you go along with your membership. There's normally no way of getting that money out of the fund, okay, except perhaps on immigration, and we've seen those rules have changed during the latest round of amendments that was promulgated in January this year. But this particular proviso says that the rules of the fund must provide that a member who discontinues their contributions prior to retirement date shall be entitled to, and it lists various things. And I've just picked up the first little sub-paragraphs. So shall be entitled to an annuity or a lump sum, or to be reinstated as a full member, or, and what we're really considering here with this particular amendment, is that they should be entitled to the payment of a lump sum if that member's interest is less than a sort of a sub-minimum amount. It used to be 7,000 Rand. So if your membership benefit, your retirement benefit within the retirement annuity fund was less than the sub-minimum amount, and you discontinued your contributions, then that would be one of the few instances where you would be allowed to have your sort of benefit paid back to you. Okay, so it used to be 7,000 Rand. As from the 1st of March 2021, that amount goes up to 15,000 Rand. So it's just dealing with very small amounts that have been invested into retirement annuity funds. If a person discontinues their contributions, in that case, with those very small amounts, less than 15,000 Rand total benefit, then that benefit could be refunded back to the member. Okay, then moving on with individuals, the next thing I want to talk about is with the travel allowance table. So this is obviously people who get a fixed travel allowance. They keep a logbook and they're looking at claiming their deductions at the end of the year of assessment. Normally, every year, the travel allowance table is increased slightly with inflationary adjustments across the various categories. Some years we have seen that the travel allowance table has remained unchanged. And on the date of the budget speech, it looked as if this was going to be one of those years. But then, lo and behold, on the 26th of February, which was on Friday, okay, 2 days after the budget speech, there was suddenly published on the SARS website this draft notice, which tells us the new travel allowance table. And actually what has happened is that these rates, the fixed cost rates and the fuel cost rates, have actually been reduced by sort of anything between 5 and 7%. The maintenance cost has gone up a little bit, but these amounts have actually been reduced, which could well mean that people end up getting a slightly less deduction, all things being equal, at the end of the next year of assessment. Okay, so please just be aware of this, that there is a new travel allowance table that has come into effect from the 1st of March 2021, running up to the end of February 2022, and that the rates on the table, certainly in terms of the fixed costs and the fuel costs, are actually lower than they were last year. What is also interesting is that when you look at the fixed travel rate, and that's especially when you look at reimbursements that employers can reimburse for occasional travel undertaken by employees up to a certain amount, and that reimbursement will be completely tax-free. That amount was R3.98 per kilometre. That has also gone down from the 1st of March 2021 and is now R3.82 per kilometre. This is per the draft public notice that was published on the SARS website on the 26th of February. All right, so if you reimburse at more than that amount, and remember that this reduced rate came in from the 1st of March 2021, if the employer reimburses at more than R3.82 per kilometre going forward, the excess amount immediately becomes taxable as part of remuneration. Okay, so that's something to bear in mind, that that has to come through in terms of the payroll, has to come into remuneration and be subject to employees' tax in basically immediately that you pay in excess of that fixed rate. Of course, this fixed rate is not available if we say that this is a tax-free rate, that if you reimburse up to this rate, it'll be totally tax-free. That is not the case if there's any other form of allowance or reimbursement paid in respect of the same vehicle. So if you're giving the person a 10,000 Rand a month travel allowance and you say we'll also reimburse you at a rate of R3.82 for any business mileage traveled, then you're not going to get a tax-free reimbursement because there's also a fixed travel allowance that has been paid in that case. All right, so please just note that that rate per kilometre has come down from the 1st of March 2021. Okay, subsistence allowances have not changed at all. So here we see that where a person is paid an allowance because they're traveling away from home for at least one night for business purposes, and they're paid an allowance to cover either meals and incidental costs or perhaps just incidental costs, they are deemed to have expended these amounts per day. So if the allowance covers meals and incidental costs, the employee is deemed to have expended $4.52 per day. So if your allowance is up to that amount, it would be tax-free. If it's intended to cover only incidental costs, then the employee is deemed to have expended 139 Rand per day. So any amount paid up to that amount would be completely tax-free. If you pay in excess of those amounts, the excess is taxable, but it will only become taxable on assessment. All right, but it would become taxable unless the employee is able to prove that they actually incurred expenditure up to the amount of the allowance that you actually pay. So there's deemed expenditure up to this amount. If the employee wants to prove higher expenditure than that, they would have to submit the necessary documentation to prove the additional expenditure. That's for travel within the Republic. If the person travels outside the Republic, then there's a separate list of rates that applies depending on where the person travels to. If they go to France, 128 euros per day. If they go to America, it's $146 per day. And you translate that using current exchange rates. So these rates per day for foreign travel haven't changed since 2019, and the statement by SARS is that that table will stay as is until further notice. So unless they specifically tell us that these rates have changed, we just go with these same rates for the foreseeable future. Okay, so nothing changed as far as your overnight stays are concerned. But what has changed is as a result of this amendment that became effective from the 1st of March 2021. This was part of the 2020 amendments. It was this change to section 8182, which talks about where a person is reimbursed for expenditure where they travel away from home for business purposes, but not overnight, where they travel away just for part of a day. So what it says is where the recipient is, by reason of the duties of their office or employment, obliged to spend part of a day away from their usual place of work or employment, and they're paid a reimbursement or advance for expenditure actually incurred by the recipient. Okay, so normally we would say reimbursements are tax-free, but one's got to be a little bit careful that it is conditional. So in this case, reimbursement is tax-free if the recipient is allowed by the principal to incur expenditure. So there needs to be a policy on the part of the employer that allows the employee to incur expenditure and be reimbursed for this expenditure. Only then will the reimbursement be seen as totally tax-free. And in terms of this amendment, which became effective from the 1st of March 2021, which does tighten this up and say that this is only exempt if the recipient is allowed by the principal to incur the expenditure and be reimbursed for the expenditure. And in addition, that the reimbursement will not exceed a certain rate per day. And here they have published a draft notice to say that the rate per day in this case will be 139 Rand per day. So that links to this daily rate for incidental costs only, where the person travels away from home for more than one night, overnight, okay? So we see the same daily rate coming through, 139 Rand per day. Okay, so it's a new subsistence rate that comes into the legislation from the 1st of March 2021, which applies to day trips. But remember that it's also that the person must be specifically allowed by the principal to incur expenditure and be reimbursed. And then the amount of the expenditure must not exceed an amount published on the SARS website. Okay. Right, and then also on individuals and the tax policy relating to individuals. Of course, a lot of discussion over the last year with COVID lockdowns and many people working from home. Many people are still working from home, maybe not quite as many as were, let's say, in March and, well, April and May last year, right through to possibly the end of last year. But with a lot of people working from home, there was a lot of discussion around the tax deductions that one could get relating to expenditure incurred for working from home. Now, there are provisions in the Income Tax Act that allow certain deductions to be claimed for home office expenses, and those link into Section 23B, which is a denial of deduction of private expenses. However, there's a caveat that, except that, expenditure relating to a home office may be allowed in certain circumstances. That has to be read together with Section 23M, which limits the deduction of expenditure for employees. So we have quite restrictive provisions around the deduction of home office expenditure. And certainly SAICA and various other tax bodies did make representation to SARS and National Treasury to ask them to consider reviewing the tax legislation relating to the deduction of home office expenditure. So in the budget speech, it was announced that in light of the large-scale migration to working at home over the last year, that National Treasury will review the travel and home office allowances. Well, I'm not sure about travel, because if a person's working at home, then you don't need to travel. But certainly home office expenditure. But they have said that they will review these deductions to investigate their efficacy, equity in application, simplicity of use, certainty for taxpayers, and compatibility with environmental objectives. In recognition of the potential effect on salary structuring, this will be a multi-year project, starting with consultations during 21-22. So for many people, the real focus on working from home has happened over the last year, perhaps less so going forward. Who knows? It depends on what happens with the adaptations to our lives as a result of COVID-19. But what this is telling me is that they will look at this going forward, and this is going to be a multi-year project. And so I think the short story is, don't expect any changes anytime soon. I think we just have to stick with the existing provisions, looking at Section 23B, Section 23M, and working around those provisions to establish what specific expenditure can be deducted. Okay, so they will look at this, but it's going to be a long-term project. Okay, on to other aspects dealing with individuals. So estate duty. Now, interesting that estate duty stays unchanged. There were many people who thought that with all the talk about wealth taxes and needing to raise additional tax revenue to cover the cost of vaccines, never mind addressing the cost of burgeoning government debt and so on, there was some thought that estate duty might increase and donations tax might increase. Interesting that it stayed exactly the same. And so we see estates up to 30 million Rand have estate duty at 20%, and then in excess of 30 million taxed at 25%. Of course, we still have the abatement of 3.5 million Rand per spouse. On the donations tax side, similarly, absolutely no change. So we see donations up to 30 million taxed at 20% and excess at 25%. Just a point to clarify that when we look at this donations up to 30 million or exceeding 30 million, what we are looking at there is the cumulative donations made by a person since the 1st of March 2018. Okay, so it's a kind of a lifetime cumulative donations, but we only started counting from the 1st of March 2018. And if your cumulative donations after starting the count from that time, once they go over 30 million Rand, remembering that we have deemed donations that come through things like Section 7C, okay? So if you bring all of these donations into effect and you have cumulative donations exceeding 30 million Rand, then the higher rate of 25% then kicks in. And it means any subsequent donations made by that person would then be taxed at 25%. Of course, we've got the annual exemption of 100,000 Rand per person per year, no change there. And for persons other than individuals, the annual exemption of 10,000 Rand per year, no change there. So absolutely no change as far as our donations tax rates and exemptions are concerned. On the CGT side, similarly, absolutely no change. So our annual exclusion still at 40,000 Rand, primary residence exclusion, 2 million, the annual exclusion in the year of death, 300,000, sale of small business assets exclusion, 1.8 million. And then I must mention that in order to qualify for that small business asset disposal exclusion of 1.8 million, the criteria, one of the criteria is that the market value of the business, of those small business assets, cannot exceed 10 million Rand. That also has remained unchanged for quite some time. So by keeping all of these thresholds unchanged, we are seeing that that is allowing fiscal drag and inflation to kind of do its work, push the value of assets over those amounts, and you end up getting additional tax in that very sneaky way, which is not a kind of a headline way of getting additional tax, but nonetheless, it does carry through. So by keeping those exemptions fixed, you're ending up getting additional tax by way of the inflationary increases to the value of these assets. I mean, if you look at a small business where the value of the assets then creeps above 10 million Rand, it means that the seller then loses that exemption altogether. All right, so it's not that you only get some of the exemption because of the increase in the value. Your value goes over 10 million, you get no exclusion whatsoever. Okay. In terms of the CGT inclusion rates, so if we take the inclusion rate for individuals, still 40%, companies and trusts still 80%. So what we're saying is that having taken off those exemptions that we spoke about on the previous slide, like your annual exclusion, your primary residence exclusion, etc., you're left with the remaining capital gain, and then multiply that by the inclusion rate to work out your taxable capital gain that then comes into taxable income under Section 26A. So with individuals, we have a 40% inclusion rate. So if we take your capital gain multiplied by 40%, then your taxable capital gain is taxed at up to a maximum marginal rate of 45. And so our effective CGT rate, 45% on 40%, is 18%. Of course, that's our maximum rate for individuals. Could be anything from 0 to 18%, depending on what the person's marginal tax rate is. For companies, the inclusion rate is 80%. The tax rate is fixed if it's other than small business corporations. And so your maximum effective tax rate is 22.4%. Of course, if this was a small business corporation, again, your actual marginal tax rate could be anything from 0 to 28%. So your effective CGT rate would be anything from 0 to 22.4%. With trusts, we have a fixed tax rate. If you do have any remaining taxable income that's taxed in the trust, it's taxed at 45%. If you've got taxable capital gain that stays in the trust and is taxed in the trust, it will be taxed at 45%, giving you an effective rate of 36%. Okay, so those are important rates to bear in mind when you're looking at how much tax you are paying on a capital gain. It's basically your marginal rate applied to the inclusion rate to give you the effective rate. Okay, then on to transfer duty. No change whatsoever. So the same tables have applied since the 1st of March 2020. No change. Bearing in mind that any value of the property exceeding 11 million is taxed at 13%. We still have this threshold value of property up to 1 million rand, no transfer duty at all. So that at least is giving people in your sort of entry-level housing to acquire their first home, acquire a home up to 1 million rand without paying any transfer duty. Of course, transfer duty applies if that does not apply. If you've got a vendor who is selling property, then it will be subject to VAT, then it is not subject to transfer duty. So it's either VAT or transfer duty, but not both. And then in terms of other withholding taxes, we spoke about dividends tax earlier, and I mentioned about the 20% and that there's no indication of whether that's going to change in the future. We do have other with national transactions. So you have interest going from South Africa to a non-resident, royalties to a non-resident, and payments to foreign entertainers and sports persons. We have this 15% withholding rate. Now, there was also some speculation ahead of the budget speech that the interest withholding tax may go up because at the moment there is scope to get more tax by way of the interest withholding tax. Nonetheless, they've kept it at 15%. Now, it's interesting that, of course, we talk about interest going from South Africa to a non-resident. If there was a double tax agreement that applied between South Africa and the country in which that non-resident is a resident, you would need to look at that double tax agreement to see whether actually it might provide for a lower rate than 15%. Many of the double tax agreements do in fact provide for lower rates, and this can apply to your interest, royalties, and your foreign entertainers and sports persons. So what we are saying is where South Africa is the source country, this is where the income is arising, it's the country of source, there's a limit on how much tax we can impose. In our domestic tax legislation, that limit is 15%, but in the double tax agreement, it might be even lower than that, in which case the lower rate would apply if the conditions of the double tax agreement have been fulfilled. When we talk about disposal of immovable property, this is a slightly different withholding tax. This is just a means of interim collection of tax on the disposal of the property, bearing in mind that if a non-resident disposes of SA immovable property, that disposal is subject to capital gains tax. Now, of course, you could wait until this person submits a tax return and then assess them, work out what your actual capital gains tax liability is, and then call upon them to settle that tax liability. That could take a long time, and perhaps it's wishful thinking as to whether you're ever going to recover that tax. So this withholding tax is a collection mechanism that operates in the interim at the time that the property is sold and payment is made to the seller, the non-resident seller of that property. This withholding has to apply. So it's based on the selling price of the property, and it will be basically 7.5% if the seller is an individual, 10% if a company, 15% if a trust. Now, of course, we just spoke about the effective CGT rates 2 slides back. So we see here that the effective CGT rate if the seller was an individual up to 18%. Here we're saying that on disposal, we'll collect 7.5%, not on the capital gain, but 7.5% on the selling price as an upfront payment. And then with the idea that the balance will be collected when that non-resident submits a tax return and gets assessed at the end of the tax year. Now, if that non-resident has no other South African tax exposure, this disposal of property is the only SA tax liability that the non-resident is going to have for the year, it is possible to get a directive to not specifically use this rate, but actually to do a more accurate calculation of what the actual capital gains tax liability would be on the disposal of the property, and then to rather withhold closer to what the actual tax liability is. So this is a kind of a default in the absence of a more accurate calculation. And it's an interim withholding with the idea of a final settlement on assessment. Okay, I think that probably brings me to a good time to take a break. It is 2:30, and then we're just about to get into the corporate tax side of things, talking about tax incentives and other aspects of corporate tax. So let's take a 15-minute break, and I will see you back at 2:45. If you have any other questions you want to pop in while we take this break, and then I'll answer your questions at the end of the tea break. Okay, so see you back at 2:45. Right, welcome back. And I hope you had a good leg stretch, nice cup of tea, and that you're ready for the second session. Okay, so I'm going to answer the questions that have come in so far. Just take a couple of minutes to deal with those. So you'll see them on the screen in front of you. Sorry, now I've gone and closed them. There we go. Right, so Ian has asked around this issue around a share buyback. And the issue around when a consideration, a company share buyback is now regarded as a dividend, subject to 20% dividends tax. And so therefore, if the whole amount of the payout on the share buyback is a dividend, then it means there's no actual proceeds. As far as the shareholder is concerned, no proceeds on disposal. They had a base cost of those shares. And now does that mean essentially that the person is sitting with a loss on that disposal? And I guess, yeah, in that case, it would be so. It's not always so. It just depends on the specific circumstances. If you look at the kind of principles around share buybacks, the company is paying the shareholder an amount to buy the shares. Now, it can be that some of that amount paid to the shareholder is a return of capital. Some might be a dividend. And in other cases, when you have a listed company doing a general repurchase in certain circumstances, it's neither a dividend nor contributed capital. In fact, the whole amount is just proceeds on disposal. So it really just depends on the circumstances. But yeah, if you are in a circumstance where the whole amount paid is in the form of a dividend, nothing is a return of contributed tax capital, then the shareholder has zero proceeds, and they would then have a capital loss on that buyback of shares. Okay, then we've got another question from Jacques around donations. Would you have to complete the donations form? Technically, you are supposed to complete the donations form for any donations made, even if they are fully exempt. I know a lot of people only practically only complete when they're making donations above 100,000. And so far, this has not really been policed all that heavily. But it really, technically, as I say, one should be completing that form for any donation. Would the donations affect estate duty? Not necessarily, not specifically. Your donations, you're looking at the 30 million. Of course, estate duty, you're looking at what's left in the estate. But yeah, I mean, in certain circumstances, you could have anti-avoidance provisions that kick in and so on. But in the ordinary course of events, no. They would not affect estate duty. So I guess what you're saying is if you had donations of more than $1 million, is that going to make your estate duty rate go up? The two are looked at quite distinctly. And then Ian makes the point about savings back in the day, in the sort of pre-1990s, I guess. We used to have all these different savings vehicles. And I remember we used to have all these detailed tables, giving away my age now, that used to come out with the budget speech showing, if I recall correctly, it did show how much you could invest in each of those items and what the sort of return was. But yes, there used to be all these different savings vehicles, and that was all changed. That was done away with and replaced with the kind of local interest exemption as we now have it. And so, yeah, so instead we've just got the one local interest exemption, so it doesn't really matter what type of vehicle you invest into. Of course, as I mentioned, you do have your tax-free savings accounts that give you a full exemption. Okay, so I hope that did answer all of your questions. All right. Okay, so if you have any other questions and you'd like me to come back to that at the end of the webinar, we can do that. Right, I'm just checking if there are any questions in the chat box. Right, so let's carry on then. Okay, so I said we're going to start looking at some of the corporate tax, looking at tax incentives. Now, there's been a lot of discussion over decades around the role of tax incentives in a tax system. Some people are very in favor of tax incentives. Others feel that you're giving away your tax base. And so government certainly for the last few years, and Davis Tax Committee did look at this, because obviously looking back at the previous commissions, the Margot Commission, the Katz Commission, and so on, they've all had their views on tax incentives. And in some cases, vehemently opposed to tax incentives on the basis that you're giving away your tax base. And so, yeah, in recent years, government has started, because they are concerned about losing tax base and shrinking tax base. And so they have announced over the last few years that they'll be looking quite closely at tax incentives to see whether they should continue with these incentives. They say, you know, it's favoring certain people and not always achieving the objectives. So maybe you're putting incentives in place to stimulate investment, economic growth. You're not always seeing the returns that you expect. And of course, tax incentives is giving away tax base. So you want to make sure that it's not giving away, but investing in, that you're going to get a return in the longer term. So in the current year, we expected to see a bit of a focus on tax incentives. I've just given some of the main ones here with their sunset dates. And some of these sunset dates have been extended, like our learnership allowance extended through to 2024. And some of the others have been extended to the dates that you see on the screen in front of you. Of course, the big one is the venture capital allowance, section 12J, which has a sunset date of the 30th of June, 2021. And the big question was whether government was going to announce an extension to this sunset date in the current budget speech. Well, this has been under a lot of discussion for the last few years. In fact, it's quite interesting to see the life cycle of this venture capital company incentive. When it was first introduced in 2009, it was put in place to provide a generous incentive for people who would invest money in high risk private equity sort of startup business investments. But initially there was very little take up of this incentive because there were a lot of terms and conditions and all sorts of restrictions that applied. And so over the next few years, National Treasury relaxed a lot of those restrictions, specifically to entice people to take up the incentive. And then they did. And I think it was also part of the whole move, as we saw kind of towards 2016, 2017, 2018, increasingly people were getting frustrated and angry with what was going on with the corruption and the sort of government lack of action on corruption, and a lot of anger from taxpayers and the feeling that they would do whatever it took to pay as little tax as possible. And so for many of your high net worth individuals, they really jumped into this venture capital company incentive in a big way, investing millions of rands because they would get a full tax deduction for the amount that they invested, and they could literally wipe out their taxable income for the year. And so actually this incentive became too successful for its own good, if I can put it that way, because then National Treasury and SARS became concerned about the loss of tax base because they were losing taxable income of their high income taxpayers. And I spoke earlier about the huge reliance on just a few million personal income taxpayers to really keep the whole tax system afloat. So then the focus was on whether we could actually sustain this venture capital company incentive. And of course, this also came on the back of increasingly kind of aggressive structures and people setting up VCC structures that were kind of pushing the envelope, and SARS and National Treasury were concerned that there was abuse that was happening. So they were looking at not extending the sunset date. On the other hand, the venture capital industry was pushing very hard for the sunset date to be extended. Of course, we do understand that when you are wanting to incentivize people to invest in high risk ventures, you would really need quite a long period of time for that to materialize. You can't just have a 5-year turnaround saying we'll have this incentive available for 5 years. You really need quite a long period of time because in many cases it's going to take a long time to get a return on your capital. Nonetheless, National Treasury announced that they had done a survey on venture capital companies. They'd looked at 100 venture capital companies. And of course, the VCC structure is such that you have a venture capital company investing in underlying qualifying companies. And so they looked at 360 of these underlying qualifying companies. And what they found is that there had been 11.5 billion rand invested into the VCC. So at that point, 100% tax deduction. Of course, last year we saw a cap on the amount of the deduction, but this was looking at previous years when there was still 100% deduction. So basically, there had been tax deductions of 11.5 billion rand given for investments into these VCCs. And then of that, 4.2 billion had gone down to qualifying company level. Of course, that in itself is not saying there's anything sinister. If you're saying what's happened to the other 7.3 billion, well, because there are certain criteria that have to be met in order for these qualifying companies to be qualifying companies. And the venture capital companies with this cash, they have to find suitable underlying companies to invest into. As I say, this is not a quick turnaround program. This is something that takes quite some time. So this is not to say that there's anything wrong with the fact that not all of the 11 billion rand had been invested down at qualifying company level, because one would expect it would take some time for this investment to go down into that level. Nonetheless, they said the total tax contribution from those underlying, the 360 qualifying companies, paid tax of 207 million for the 2019-20 fiscal year. And half of that actually came in the form of value-added tax. Again, that in itself, I don't think is anything sinister, because we are talking about, by and large, new startup companies that would often have assessed losses in the first few years of operation, not necessarily going to immediately become high tax-paying companies. So I don't necessarily think that's a bad thing, but nonetheless, these were all aspects that featured in their research. Then they looked at how many people the qualifying companies were employing to see whether this incentive was actually achieving, obviously, what is one of the key objectives within our economic system, and that is to create jobs. They said, well, these qualifying companies have employed an additional 8,000 people, of which 4,000 were in direct employment. And only 37% of the qualifying companies actually added new jobs after receiving the VCC funding. So they're saying, it's not really what they were expecting to see in terms of job creation. So they said over 50% of the investments actually seem to be in low-risk movable asset rental structures, low-risk income-producing investments, and guaranteed return real estate investments, whereas their intention was that obviously this would be investments going down into trading companies that would create jobs and help to promote economic growth. They did say that their findings broadly corresponding with similar research conducted by the Venture Capital Association, that their outcomes in terms of predictions on job creation and tax estimates differed. And at the end of the day, they said that since 2015-16, there's been 1.8 billion rand of tax revenue foregone, of which 1.7 billion rand went to individuals who had taxable income and VCC investment above 1.5 million. So it was going to your high income earners. The revenue foregone in 2018-19 was almost R1 billion before the deduction cap of 2.5 million was introduced. So they're saying based on that research, that persuaded them that they should not extend the sunset date, because the incentive was really giving a benefit to your high net worth taxpayers, and it was having limited economic impact. Yeah, so that has seen the demise of the venture capital incentive. So the incentive is still open up to the end of June 2021, but that is the sunset date, and thereafter no further investments into a venture capital company will qualify for the incentive. In the meantime, of course, we have the incentive that is capped, 2.5 million rand for individuals, 5 million for companies. That cap was introduced last year. Right. And then your specific excise duties, of course, sin taxes, always a big focus of the budget speech. How much more are we going to pay for the beer, wine, cigarettes, and so on? And in this budget speech, we saw an 8% increase in the sin taxes. And that is expected to produce an extra 1.8 billion rand of tax revenue. 1.1 billion from sale of alcohol, and almost R1 billion from the sale of tobacco. So as I was saying earlier, when I spoke about the tax collections from specific excise duties, these are big tax generators. Some people might say, well, why didn't we increase sin taxes even further? Because, you know, people would still pay, and you would still collect the taxes. And maybe it might even change behavior if you get to the point of really significantly increasing sin taxes. Nonetheless, the decision was made 8% across the board, well, almost across the board. And then, of course, they are also now taxing your heated tobacco products, taxes 75% of the cigarette excise rate, and they're looking at introducing tax on e-cigarettes in 2021. So they will then publish a discussion paper on how to go about taxing your e-cigarettes. So with the 8% increase, you can see your increase in the price of various products, from beer, wine, sparkling wine, etc. The only product that has not had an increase is sorghum beer, and that has been the case for the last 20 years. We've not seen any increases there because the motivation is that that's really a health product, not just specifically an alcoholic product, and so they don't change the excise duties there. But on all of your other alcohol and cigarettes, you see that the prices went up from the date of the budget speech on the 24th of February. Okay, and I spoke about the revenue collections earlier, so I don't think we need to look at that again. On the fuel levies, we see that from the 7th of April, so next month, this is just after the Easter weekend, so it gives you a chance to go on holiday, get back, and then the fuel price will go up by 27 cents per litre. That's comprised of 15 cents per litre on the general fuel levy, 11 cents per litre road accident fund levy, and then 1 cent per litre increase in the carbon fuel levy. So that adds up to your 27 cents per litre increase. And that increase applies to both petrol and diesel. So what we'll see is the total fuel levy on petrol goes from 5.88 up to 6.15, and on diesel goes from 5.74 up to 6.01 per litre. Okay, so that's sort of between 35 and 40% of the pump price of petrol. Just depends on what the pump price is. Of course, that goes up and sometimes comes down, but it's around about 35% of the pump price that we're paying by way of fuel levies. It's a big amount of tax that we're paying on fuel. And of course, a big aspect of fuel levies is that it is a very regressive tax. And yet, there seems to be no reluctance in curbing the increase in the fuel levy every year. I guess it's a less visible tax, as opposed to value-added tax, where you change the tax rate and people immediately notice the impact in terms of their prices at Pick and Pay and so on. Whereas the fuel levy, you just pay your fuel price, and then hidden within that is the fuel levy. So people, and especially if people are using public transport, taxis and so on, they don't immediately notice the increase in the fuel levy. But it's there nonetheless, one of our many stealth taxes that exists. If we look at fuel levy revenue collections over the years, quite healthy collections. In the last year, running up until the end of March this year, as I mentioned on the earlier slide, right at the beginning, I said we're about 8 billion Rand short of budget. Last year, we were also a bit short of budget, but prior to that, we've always come out pretty close to budget. And of course, yeah, it remains to be seen what happens over this next year, how accurate the budgeting is and how much people are actually going to travel. That will factor into what sort of fuel levy we actually collect. Then other taxes that come in, diamond export levy is one that's not often mentioned, but it actually generates enough tax to get mentioned on its own in our list of taxes that's published with the budget speech. And this was a tax that was actually introduced reasonably recently from the 1st of November 2008, 5% on the value of unpolished diamonds that are exported from South Africa. And it's aiming to promote the development of the local economy by encouraging the local diamond industry not to export, but to rather process those diamonds locally. It's one of the big challenges of the South African economy is we tend to send out raw material, gold, diamonds, all sorts of things. We send it out, it gets produced, and then we import it back again. Whereas the idea is we should rather develop these things within the South African economy. So here's one tax that was introduced to try and encourage local beneficiation. Whether it's really had the desired effect, it certainly has not been terribly visible. Okay, but it is a levy that exists. And if we look at how much tax has been collected, it has collected, as I say, a reasonable amount over the last number of years. And we see reasonable increases coming through there. Although this year, again, a drop. So does that mean that, and almost like half of what we should have collected, does that mean that with the COVID-19 lockdown, there were fewer diamonds that were exported? It would seem to be the case. So yeah, it's just quite interesting to see that even on something like the diamond export levy, we see that that tax collection was depressed in this current fiscal year, presumably relating to the COVID-19 restrictions. Carbon tax, of course, the big sort of headline environmental tax that was introduced in June 2019. And that was introduced under the Carbon Tax Act of 2019, which contained within it inflationary increases that would take place all the way up to December 2022. So that act actually provides that every year the rate will increase by annual inflation plus 2%. And so in January 2020, and this happens from the 1st of January every year, we saw a 5.6% increase from 120 through to 127. And then from January this year, 5.5% increase from 127 up to 134. January next year, there will be a similar increase, annual inflation plus 2%. So it remains to be seen what the annual inflation rate is. Add 2% onto that, that will be the next increase in the rate. So this is certainly happening and is starting to contribute taxes. But of course, we know that initially, to get the carbon tax going, there's quite a lot of offsets that happen. So it will be a few years before we actually see significant revenue numbers being reported relating to the carbon tax. Nonetheless, it is there and it is operating. Another thing that's there and has been for a few years and is operating is the health promotion levy, or the sugar tax, which was introduced in April 2018. And that looks at sugary drinks, fizzy drinks, and it's looking at how much sugar is within those cold drinks. And if the sugar content exceeds 4 grams per 100 milliliters, then you're paying sugar tax on that excess. So the first 4 grams per 100 mils you can have without paying tax. If you, for example, have a sugar content of 6 grams per 100 milliliters, then you would take that excess of 2 grams multiplied by 2.1 cents per gram. And that's how it would work out, cents per gram, and then that rate would be paid. So basically what we have now is that rate went up from the 1st of April 2019 to 2.21 cents per gram in excess of 4 grams per 100 milliliters. And the rate has stayed the same since then. If we look at how much tax we are collecting from the health promotions levy, this certainly is generating quite a lot of tax. And quite interesting to see how it kind of started off where our actual collections were way in excess of what was budgeted for. We budgeted 1.9 billion, we got 3.2 billion. Very nice excess of 1.3 billion rand. The next year again, we were in excess to the tune of £500 million rand. But this year, we budgeted 2.8 and we only ended up with 2. So we were 900 million rand short. So almost R1 billion short of budget. Now, I mean, is this related to the COVID-19 lockdown? My suspicions are that this is not so much related to the COVID-19 lockdown as it is related to the trends that have emerged. So what has happened is that your cool drink manufacturers, in many cases, have changed recipes so that they are producing cool drinks that have very little or no sugar. And people tend to buy those products. So we're seeing a shift in consumerism, and we are also seeing the manufacturers, even on full sugar products, we've seen their recipes change, that those products contain less sugar than what they did 2 or 3 years ago. And so that's translating to less tax. So it's interesting because one of the questions that arose when sugar tax was introduced is whether this sugar tax would have a limited lifespan because it would become kind of self-defeating after a while, that it would have the desired effect that people would buy sugar-free drinks and then eventually you would lose this source of revenue and it would just kind of fall away. Well, I'm not suggesting that that's necessarily going to happen immediately, but perhaps over the longer term, we are going to see a continued decrease in the amount of sugar tax that we collect every year. Then other environmental taxes, this incandescent globe tax, well, no change this year, but we saw last year that the rate went up and now stays at 10 Rand per bulb. We see the plastic bag levy also changed last year, a significant increase from 12 cents to 25 cents per bag. This applies to your plastic shopping bags. It doesn't apply to bags used for wrapping or packaging like Ziploc bags and household bags, refuse bags and so on, but it does apply to your grocery bags. However, many shops now have moved towards your bio bags. And the question is whether we should have plastic bag levy on these bio bags, because surely they are there to be environmentally friendly. Nonetheless, National Treasury's attitude is that although these are made from renewable feedstocks, such as sugarcane and food residue, and they emit less greenhouse gases, but they still contribute to littering and marine pollution, and therefore there's still a levy on these bags, but there is a reduced levy from 1st of April this year. Well, I haven't specifically announced the date yet, but it would seem the trend is from the 1st of April, so it would seem that it would be from the 1st of April 21 that this rate will be 12.5 cents per bag on your bio bags. Okay, and all your other bags, 25 cents per bag. Okay, and then of course your environmental levy on electricity, again, levied on electricity generated from non-renewable sources. We seem to be at self-competing odds here in terms of relying on Eskom and then having this levy on electricity generated from non-renewable sources, and yet not opening the way for renewable energy to really emerge. Nonetheless, we've got this levy that's there, been there since 2009, and it's currently levied at 3.5 cents per kilowatt hour, which will come through in the tariff that you pay for the electricity that we get from Eskom. Okay, and the point is that it hasn't changed since 2012. Motor vehicle emissions tax, another form of environmental tax, and I'm not going to go through all of this table here, but just to show you the trend of how this emissions tax has emerged. And basically what happens is that this tax is paid on the manufacture and then sale of a vehicle that has emissions above a certain rate. So as an example, SARS has this calculation that shows you how the tax would be paid. So if you had a car that is sold and it has an emission of 140 grams of carbon per kilometer, carbon dioxide, then you would say, what is that above the threshold, which is now at 95 grams per 100 grams per kilometer. And you say the excess is 45 multiplied by this rate of 120 Rand per grams exceeding that threshold, and you come out at this amount of 5,400 Rand. So that would then be added onto the price of the vehicle. And you would see that if you're lucky enough to be able to buy a car and you get an invoice showing you the purchase price of the car, it will show you that emissions tax that is there. And on that, on the price of the car plus the emissions tax, you then pay the VAT. Okay, then of course another type of environmental tax. I told you we had a lot of stealth taxes in South Africa. This environmental tax is on tires. We haven't seen an increase since 2016, but it is a tax that is there, and it applies to your tires imported into South Africa. Okay, so that's really the end of all of the announcements around tax rates. And now I'm just going to give you just a table that just for your reference in terms of the current SARS interest rates. Remember that there are 3 tables that are published on the SARS website. Table 1 deals with interest payable to SARS if you owe SARS money, and currently that's sitting at 7% per annum. If SARS is owing you money and you're lucky enough to get interest paid to you by SARS, that interest is calculated at 3% per annum. And then there's another one on table 3, which is what we call the official rate of interest. And that's the rate of interest that we use when we compare whether you are paying a market-related rate. For example, Section 7C, dealing with loans to trusts, loans to companies owned by trusts. Is it an interest-free loan or a low-interest loan? The benchmark is this official rate of interest, which is currently sitting at 4.5% per annum. So if your interest rate is less than that, then you've got a low interest loan. Similarly, if you have a loan advanced from an employer to an employee, it will be a low interest loan if it's carrying interest less than this rate, and then the difference would give rise to a fringe benefit. Okay, so just an update on those 3 rates. So all of these rates move in tandem with the repo rate as set by the Reserve Bank. The reason why we see a change in the effective date is that as the repo rate changes, we see that the official rate of interest changes the first day of the following month, and these dates change the first day of the 4th month. Okay, so it's basically 3 months later that these dates change. So it's all linked to the same change in the repo rate. It's just that these interest rate changes flow through at different times. Okay, so those are the current SARS interest rates. Right. So my question that I'm having a look at here from Anonymous says alcohol consumption reduced, so less mixes. Oh, okay, linked. So your gin and tonic, all right, or your brandy and Coke. So if you can't have brandy, you're not going to have Coke. If you don't have gin, you're not going to have tonic. So yes, going back to the reason why our sugar taxes have dropped, could be linked to that. Good observation. Okay, right. So let's go on to the next part of the discussion, which is looking at our Annexure C proposed amendments. So what we're talking about now, Annexure C lists all of the technical amendments that are going to come through over the next year. So these will then be the amendments that come through in the Taxation Laws Amendment Bill and the Tax Administration Laws Amendment Bill. So these are, you know, apart from the rate changes that we've covered up until now, we get these legislative changes, which are technical changes. All right, so these are the proposals. Now, what happens with Annexure C, let me just go back here for a moment, is that towards the end of every year, in about August, September, thereabouts, there's a call for comment that goes out from National Treasury, calling for people to provide input on what changes are needed. So if there's any problem in the legislation, if there's an error in one of the provisions, or something's not achieving what it should be achieving, or perhaps it's achieving the wrong thing, it's achieving double tax or something like that, then people can bring that to the attention of National Treasury, and they then put that into Annexure C. So it's what we call our Annexure C amendments. Of course, it doesn't all come from the tax-paying communities. Sometimes SARS and National Treasury also identify their own problems or things that they want to change, and they put that into Annexure C to say these are the technical changes that are going to happen over the course of the next year. Okay, so this is the list that has been put out in this year's budget speech. Long service awards. Now, in terms of paragraph 5 of the 7th schedule, we talk about assets awarded to employees, and normally the employer gives an asset to an employee that would normally give rise to a taxable benefit, right? But there is a nil benefit. In other words, there's an exemption that comes through this proviso. It's the second proviso to paragraph 5.2, and that says that if it's an asset that is given to the employee as a long service award, then there's a nil value on that benefit as long as the value of the asset does not exceed 5,000 Rand. And long service is then defined as an initial unbroken period of at least 15 years or any subsequent unbroken period of at least 10 years. But it is talking about an asset awarded to an employee with a value not exceeding 5,000 Rand. And so what's been mentioned in the Annexure C is that employers recognize long service through awards in a variety of forms that could be considered non-cash benefits. The point of the matter is, if it's cash, it's taxable, okay? If it's an asset with a value not exceeding 5,000, then it's nil value. But what about other non-cash benefits that are maybe not specifically assets, but there are other types of awards that are given? So they are proposing to relook at the provisions of paragraph 5.2 to consider whether other awards within the same limit should also be treated as long service awards. So it remains to be seen what comes through there. Okay, then targeting tax abuse. They're saying that there is abuse of the employment tax incentive, which was introduced, I'm sure you're all aware, to reduce the cost of hiring young people between the ages of 18 and 29. And that comes through a set-off against your PAYE. So the employer claims a credit as long as you get a monthly remuneration of less than 6,500 Rand to the qualifying employees. And there's certain limitations that come into play there, but in essence, you could claim up to 1,000 Rand per month against your PAYE per qualifying employee. Now, of course, as I mentioned earlier, whenever there's an incentive, then there's lots of people who want to maximize their use of the incentive. And sometimes people push the boundaries on this, and sometimes they overstep the mark. Now, here we've seen that various schemes have been devised, and some that we might perceive as being quite dodgy. In fact, some have been highlighted by SAICA, brought to the attention of SAICA by members of SAICA who've seen this operating in practice. And some of these schemes basically sign up trainees who then go and study at a training institution. They never actually work for the company. The company signs them up as an employee, and then the person goes and studies something. And then the company treats them as an employee and claims the employment tax incentive. There's other even more aggressive ones where they have ghost employees. I mean, that to me is just blatant evasion and should be treated as such. But this particular scheme, which uses trainees, this is the one that is going to be targeted. And they're going to tighten up on the definition of employee, which at the moment is a little bit loose, to specify that if it's an employee, it must be somebody who's required to actually do some work in terms of an employment contract that adheres to the basic conditions of Employment Act. And that will take effect from the 1st of March 2021. So it's really important to take note that although these amendments have not even been drafted yet, certainly have not been promulgated yet, they might only be promulgated in January next year. But we've already been told that once they come into existence, they will be effective 1st of March 2021, because it's addressing a tax avoidance scheme. It's an anti-avoidance measure. And so in effect, it is going to be retrospective in its application. So just be careful of that. Then in terms of deceased estates, they're going to clarify the time of disposal. They say there's been some uncertainty around when assets are actually distributed to the heirs. And so they talk about the L&D account being served before the Master of the High Court. And they're saying that what they will do is they will clarify the time of disposal from a deceased estate as being basically when the L&D account becomes final. So that will just bring clarity. Okay, it's still got to come into the legislation, but they are looking at bringing that in. That will be in terms of the Estate Duty Act, because it's talking about time of disposal from the deceased estate. And also it links in, I guess, with our provisions with the Income Tax Act. Then we've got two anti-avoidance provisions dealing with trusts. This one talking about the cession of a right to receive an asset, and it's talking about somebody who has undertaken work. It's a service provider. They're due to receive an asset in return for the services rendered. Now, normally, of course, any amount you receive in respect of services rendered comes into gross income. And if you give away an asset for proceeds consideration less than the value of the asset, that would normally give rise to a donation subject to donations tax. Schemes have been devised to circumvent both the gross income side of things and the donation side of things by ensuring that the person cedes their rights, they divest themselves of the asset before the asset really has any value. And so these schemes, obviously, you know, you're ceding something, and from donations tax point of view, you're giving away something, but there is no value on the asset at the time that you do the cession. So there's no value on the donation. And you are receiving something in return for services, but there's no value attached to it at that point. So there's nothing to come into gross income. So these schemes to transfer rights to assets to a trust before any value actually attaches to that right are the ones that are being targeted in terms of this anti-avoidance provision. And so they've said they're going to bring into light amendments to address these kinds of schemes. The other kind of scheme involving trusts is coming back to this whole issue of Section 7C. Of course, Section 7C is the provision that creates the deemed donation on interest-free or low-interest loans to trusts, and now has been extended, well, for a while now, has been extended to companies owned by trusts, and as of this year has now also been extended to preference share structures, where preference shares are issued by companies owned by trusts and so on. So what we've seen over the years is that the scope of Section 7C has been expanded to try and address as many of the kind of targeted structures as possible. Whenever you have anti-avoidance provisions, as much as you put anti-avoidance provisions in place, there are always schemes that kind of seek to bypass the effect of the anti-avoidance provision. So here we see that schemes have been set up to try and avoid the application of Section 7C by transferring loans, which finance high value assets basically from one trust to another. From one trust to another where the founder of the trust is related to the beneficiaries of the first trust, or vice versa. So they're trusts where there is this kind of, there is a connected person situation. Remember, beneficiaries to a trust are connected persons to the trust. The founder of the trust is not necessarily a connected person unless he's a beneficiary, but the founder could be related to the beneficiaries. And so you could have a connected person situation there. So anyway, the key point is that they are looking at loans that are transferred to try and circumvent or sidestep the application of Section 7C. And they are proposing a further amendment to Section 7C to counter these types of schemes. Okay, so these two anti-avoidance provisions dealing with trusts. Then we get on to a whole range of amendments dealing with retirement funds and retirement benefits. I guess the most controversial one is this one talking about your retirement benefits after ceasing to be a resident. We saw that in the latest round of amendments, the 2020 Taxation Laws Amendment Act that was promulgated in January 2021 had the amendment that spoke about a person who ceases to be a resident and is no longer a resident and takes out the money out of their preservation fund or their retirement annuity fund. And the amendment that's come through is that as from the 1st of March 2021, you will not be able to access that benefit if it's a withdrawal benefit. If you haven't yet reached retirement age, you will not be allowed to take that money out until you have been able to prove that you've been a non-resident for at least 3 years. So that 3-year rule has come into effect from the 1st of March 2021. This is now another aspect of retirement benefits. This talks about a person who was a member of a retirement fund when they were a resident. They then ceased to be a resident. So it starts off by saying that when a person ceases to be SA tax resident, and of course this is going to be the key definition, it is now the key definition going forward. We no longer talk about a resident in terms of the Reserve Bank. We talk about tax resident in terms of the Income Tax Act. So if a person ceases to be tax resident, then basically they're deemed to have withdrawn from their retirement fund at the point of ceasing to be a resident. However, if they retain their investment in the retirement fund and then only later access the fund benefit when they die or retire, then of course at that stage, this is now no longer a withdrawal benefit, it's then a retirement benefit. The question is, how is that retirement benefit going to be taxed? Now, we do have Section 921, which talks about pension benefits, and it deems those amounts to be from a South African source if it's paid by a South African approved fund. So if you have a non-resident who's paid a lump sum from a South African fund, it is South African source income, potentially still taxed in South Africa, because remember, non-residents are taxed in South Africa on SA source income. However, we also have to look at the double tax agreement. So if this person in the meantime has become tax resident of country X, then you'd pick up the double tax agreement between South Africa and company X and see what that double tax agreement says around the treatment of pension benefits. Now, most of the tax treaties between South Africa and other countries typically provide that retirement benefits are taxed only in the country of residence. So if this person is now a resident of country X, even though they're taking a lump sum from the South African fund, which is South African source, but the DTA says that's taxed only in the country of residence, then it's only going to be taxable potentially in country X, and South Africa loses its taxing rights. It loses its ability to tax this money. But in all cases, when you have a double tax agreement that favors the country of residence, it would usually give the ability for the source country to tax, but only up to a certain amount. So South Africa is looking at making use of this opportunity, and the way that it's doing it is to say, at the point that you cease to be a resident, you deem to have taken a withdrawal benefit, and we will work out how much tax would be paid on that benefit. If you don't take the money out of the fund, then you don't have to pay that tax right then and there. We will defer the tax payment until you actually take the investment at the time that you retire, or perhaps if the person dies before they retire. At that stage, we would then work out what the amount of tax would be and work out this notional amount of tax that would have been paid at the time that you cease to be a resident. But you see what they're doing is that they're kind of pegging that tax liability at the point of ceasing to be a resident, albeit that tax only becomes payable later when the lump sum is actually paid out. And of course, that's in line with the ability to pay principal. Can't really tax people if they've got no cash available to pay the tax. But we are pegging our right to tax by saying that that is a tax liability that arises immediately before the person ceases to be a tax resident, that we will only claim that tax when they actually get a payout from the fund later on, which would then be a retirement benefit. So they're looking to change the legislation to basically build this into the legislation. So you'll see there, I'm just going to just cut to the bottom bullet point because I've explained the rest of it. It says, when the individual eventually receives the payment from the fund, then you're going to work out the tax according to the prevailing lump sum tables. And yeah, you would give a credit for any amount that had been paid when the person ceased to be tax resident. But the idea is that we are establishing a tax liability which might only become, well, which would become payable maybe only in the future when the person actually retires from that fund. Okay, otherwise South Africa would lose the ability to tax those retirement benefits altogether, which it does seem to be a bit unfair, bearing in mind that those savings have accumulated while the person was resident, and that's money that has been sitting in a retirement fund in South Africa. And remember that we don't tax those savings within the fund. The idea is that they would only be taxed when they're paid out of the fund. And if we lose our ability to tax that, then what we've actually lost is maybe decades worth of potential tax that is then lost because of the application of the double tax agreement. So it doesn't seem to be an entirely unfair treatment, but of course it might cause a little bit of concern with people who are planning to immigrate from South Africa. Okay, then some of the other amendments that are coming through dealing with retirement benefits and retirement funds. So in this case, looking at providing more options around acquiring annuities on retirement. So currently what we have is, and remember, as from the 1st of March, all funds have now moved to compulsory annuitization, provident funds as well. Yes, there is a protection of vested rights for people over the age of 55, etc. Okay, but for other people, basically, when they take out their retirement benefit, whether it's a pension, provident, or retirement annuity fund going forward, they can take a maximum 1/3 as a lump sum. The other 2/3 of their retirement benefit must be converted to an annuity. So at least 2/3, okay, 2/3 or more must be converted by an annuity. Now, the way that that currently happens is that either the fund itself pays the annuity to the member, or they use that money to then buy an annuity from an insurance company. So only those two options are available. The statement in the budget speech is to increase flexibility for a retiring member and maximize the retirement capital available to provide for an annuity. Government proposes expanding the amount of retirement interest that may be used to acquire annuities. A little bit blurry as to exactly what they're planning here. But some of the comment that they did put out in the budget speech tended to indicate that they want to make more options available for employees, for members to basically acquire annuities, not just these two options that we have currently. If you look at the wording there, though, maximizing the retirement capital available to provide for an annuity tends to indicate that they might be looking at, going above 2/3. They haven't specifically highlighted that. I'm just reading a little bit between the lines here. But let's hope that it is just a positive amendment that's looking at giving people more options around acquiring annuities, that they could perhaps acquire their own annuity, not only have to rely on the fund going and buying an annuity from the insurance company. Then transfers between retirement funds by members who are 55 years or older. So what we see from the 1st of March 21, as a result of provident funds now coming onto compulsory annuitization, is that we see that the playing fields are a lot more relaxed now in terms of transferring tax-free transfers between funds. It used to be that you could only transfer from provident to pension and not vice versa. that as from the 1st of March 2021, you can now transfer provident fund to pension fund to provident fund, because provident funds are subject now to the same annuitization rules as pension funds. So they're kind of on an equal footing. Of course, retirement annuity fund, you can only transfer to another retirement annuity fund. And even then, I think that's going to be quite difficult to do. Okay, but what they're proposing here is to allow members of a pension, provident, or retirement annuity fund, if they choose to retire early, then they should be able to transfer to another similar or more restrictive fund on a tax-free basis. So opening up options to transfer to different funds if the person is taking early retirement. Again, on funds, looking at benefit funds, retirement funds. So when we've got a contribution to a defined benefit fund, sorry, I'm getting myself tongue-tied. When we've got a contribution to a defined contribution fund, okay, then the fringe benefit value is the amount of the contribution paid by the employer in terms of the 7th schedule. There has been a bit of confusion if that retirement fund provides both a retirement benefit and a self-insured risk benefit. So the amount that the employer is paying to the fund is actually providing both the retirement benefit and a self-insured risk benefit. And the question is then, are you supposed to separate the contribution between these two elements? It's caused quite a bit of confusion over the last few years, and they want to clarify that self-insured risk benefits should be classified as a defined benefit, as a defined contribution component, to ensure that retirement funds that provide both the contribution component and the insurance, the self-insured risk benefits, can provide the fringe benefit value based on the actual contribution. So it's the whole contribution is the amount of the fringe benefit. Okay, then on to corporate tax. They want to clarify the definition of contributed tax capital. Part of the, when I was talking about Ian's query earlier around share buybacks, and I was talking about contributed tax capital versus dividends. So when you have an amount going from a company to a shareholder, it's either a return of capital or it's a dividend. A return of capital is what we refer to as contributed tax capital. It's kind of like the permanent capital of the company that could be paid back to shareholders. There is a proviso within the definition of contributed tax capital that if you have a certain class of shares, and let's say your contributed tax capital for that class of shares is R1 million, and you have 1,000 shareholders, and you pay back contributed tax capital to the shareholders, it's deemed that your return of contributed tax capital cannot exceed an amount being the actual total return of contributed tax capital evenly distributed between your different shareholders, so divided by the number of shares. So it's got that limitation rule. Now, some people are arguing that if you have one shareholder that pays a premium, a big premium in to acquire the shares within that class, but the other shareholders paid a lesser amount of money for those shares, do you still have to share the CTC evenly across the number of shares? And so they want to clarify that indeed this is the case. They want to clarify that shareholders within the same class of shares should share equally in the allocation of CTC. Even if one shareholder pays in more than the others, if it's the same class of shares, then your CTC is deemed to be spread equally according to the number of shares held, not according to how much money each shareholder put in. Then they're looking again, anti-avoidance rules constantly receive attention. This anti-avoidance rule of 8F, it talks about hybrid debt instruments, and hybrid debt instruments is where interest is paid and the company would look at claiming a deduction of the interest, but because it falls into section 8F, that is deemed to be a dividend. Okay, so what happens there is that the instrument that exhibits equity features or returns basically deems the returns to be dividends in specie. Okay, so they don't get a deduction of interest. In fact, they end up having to pay dividends tax. But the provision doesn't do the equal and opposite for the person who's receiving the interest. So the person who's receiving the interest is taxed on the interest income as income. I mean, this has been the case for a long time, but now it comes to light that this is unfair. It leads to double taxation, and they want to clarify and bring some balance here. if you're losing the tax deduction on the one side, then possibly the recipient should not be fully taxed on the income on the other side, because it does lead to double taxation. And then on the debt reduction rules of section 19 and paragraph 12A, talking about when you convert debt to equity. Currently, when we talk about debt, we're talking about debt excluding interest, but they want to perhaps clarify that and maybe amend the definition to include interest in the debt as opposed to excluding interest. Then the next few amendments, and I'm really not going to talk about them in a lot of detail. I've got them on the slide here for those who are interested. I'm just going to literally read the headings to you. These are all amendments that deal with corporate restructuring provisions. And of course, it does get fairly complex, and it's a fairly narrow field. I'm not sure, all of you are dealing with this. So I just want to highlight that these changes are coming through. Of course, when you do our year-end tax update, once all this legislation has been through discussion and so on, we'll pick up the final amendments and talk about the final amendments at that stage. So just be aware that the interaction between value shifting, the section 24BA value shifting rules, and the corporate reorganization rules, specifically section 40CA, which talks about the base cost of an asset that is acquired through an asset for share exchange. So they did some amendments to these sections last year. They found that there's still an anomaly that exists. They want to sort that out. So there's going to be an amendment, a further amendment that comes through this year. And then other amendments, the corporate restructuring rules, I've listed them all there. So you can see there's quite a few. Again, quite a few of these amendments link back to amendments that were made last year, which link back to amendments that were made in the year before that. These are extremely complex provisions. And of course, a lot of the complexity comes to light in the application of when you actually do mergers and acquisitions and so on. And then the problems actually emerge. So yeah, there's still some areas where the anti-avoidance provisions, for argument's sake, end up in a double tax situation that was not intended, National Treasury says. So they want to sort these things out and make sure that it's properly streamlined. And yeah, so there's quite a few of these amendments that are going to be coming through over the course of the next year. But there's usually these draft amendments that come out around the corporate restructuring rules, and even the previous one that I mentioned with section 24BA value shifting. Usually a huge amount of debate and discussion goes on around these, and often what emerges at the end of the day is not really exactly what was mentioned in the budget speech. So let's wait and see what comes through in the actual legislation. On the international tax as well, of course, quite a complex space. And so with controlled foreign companies, we see two proposed amendments coming here. The one dealing with the diversionary rules. When you talk about a foreign business establishment, and it seems that there are people who've been setting up structures to try and sidestep some of the rules that apply there. And then also, we saw last year an amendment coming through in anticipation of allowing loop structures, which are now allowed. And they were talking about limiting the participation exemption under paragraph 64B of the 8th schedule. And there's some further amendments coming through there, dealing with when a CFC ceases to be a CFC. Also on the international tax side with royalties withholding tax, they want to bring this more in line with the interest withholding tax, which currently says that if you're non-resident, remember interest withholding tax, I said, applies when you've got interest paid from South Africa to a non-resident, okay? If that non-resident is either exempt from the interest or is eligible for a rate lower than 15% because of the application of a double tax agreement, then that recipient would submit the declaration and undertaking to say that they are eligible for the exemption or the lower rate. They want to introduce a similar provision for royalties withholding tax. So that's going to come through over the next year. Then various VAT amendments, this one dealing with VAT refunds on gold. If any of you have followed the Rapper case, which came through the Supreme Court of Appeal just a couple of months ago, and that dealt with VAT refunds that had been withheld for an extended period of time, and then the matter went actually to the High Court to seek relief, to instruct SARS to basically pay the refund. And the court said that, it was not right that SARS should delay refunds indefinitely and drag audits on and on. But SARS' rebuttal to that was that in that particular industry, when you're dealing with people who are trading in gold and exporting gold, they perceived that there were some avoidance and evasion schemes and some malpractice going on around that refunds. So as much as they got a rap over the wrist from the judgment that said that, you know, they should basically get a move on in paying back the VAT refunds, they've then said, well, they were going to make some proposals to change the legislation to tighten up the VAT refunds on these transactions, dealing specifically with gold trading. Then on insurance, they want to align the VAT Act with the new Insurance Act to provide for micro insurance businesses. Then on the question of temporary letting of residential property, this is a long saga that goes all the way back to the 2010 budget review, and it links back to the VAT Act, which talks about the change of use. So if you have a vendor who has acquired goods or services for the purposes of using that in making a taxable supply, the vendor claims the input tax credit, right, on the acquisition or the incurral of that expenditure, because they're going to use that for making taxable supplies. If they end up not using that for making taxable supplies, then there's normally a clawback of that input tax. Now, in the case of property, we have the same provision. Section 8(1) of the VAT Act requires output tax adjustment when the property is no longer used for the purpose of making taxable supplies. Now, with property developers, this came to light when they were developing residential property, claiming the input tax, but then they were unable to sell the property. And so to assist them with cash flow, they would either rent out the property or maybe move into the property themselves. Now, the issue was that they then had a change of use, and they then have to raise output tax, and that's done on the basis of a deemed supply equal to the market value of the property when the property is let for the first time. There was some relief that was brought in, and this followed the 2010 budget review, and it actually came through in the following year, 2011, effective 10 January 2012. And that basically provided this relief that said for 3 years, you know, if you rent out the property for the first 3 years, then there's no deemed supply. That was then extended up to the end of December 17. And then it kind of died, and it was not extended after that. However, in the 2010 budget review, the statement was made that they needed to investigate and determine an equitable value and rate of the clawback for developers, as the current treatment is disproportionate to the exempt temporary rental income. Yeah, I mean, if you're developing a property and it has a value of 5 million rand, you rent out that property currently. As soon as you start renting it out, because you no longer have this 3-year protection, so as soon as you start renting out the property, you've got to now have a deemed supply equal to 5 million rand, and you've got to pay the VAT on that at using the 15%, because the deemed supply happens now, right? Doesn't matter when you claim the input tax. So you've got a 5 million rand supply, but you might only be renting out this property for a few months. So it is kind of inequitable in terms of the value of the deemed supply versus the actual rental, in other words, the mischief that they are targeting. So they now are saying that they actually need to go back and relook at this matter. So even though it's been sort of in process for more than 10 years, they have said they're going to go back and have a look at this again. So we expect to see some amendments coming through in the next year. So maybe that will give some further relief to your property developers. Remains to be seen. On the tax administration side, they want to tighten up on your Section 18A certificates that you have to have if you want to claim a donation to a PBO. So they are going to enhance the information required, more information. They're also going to put this into a third-party data system. So it'll be pre-populating, etc. So yeah, that hopefully is going to cut down on fictitious and incorrect receipts being issued. They're also going to have an amendment looking at refund of dividends tax on dividends in specie, linking the time frame. So there is a provision to refund dividends tax on cash dividends, as long as that's the claim is submitted within 3 years from the date of payment of the dividend. With a dividend in specie, the 3 years runs from the date of payment of the dividends tax. So they're just going to bring those two time frames in alignment. And then on the EMP 501 returns, this is something that you need to pay attention to, is, of course, there is the penalty in paragraph 14 of the 4th schedule, 14.6 it is, which says that if your EMP 501 returns, that's your 6 monthly returns, if they're not submitted on time or if they have an error, then there's a penalty which could go up as high as 10% of the employee's tax withheld during that period. The problem raised by SARS is that if the employer is so non-compliant that they haven't been submitting their EMP 201s, their monthly returns, or their 6 monthly returns, SARS doesn't know how much employees' tax has been withheld over the period, and so they've got nothing on which to base the penalty. So now they want to introduce an amendment that allows SARS to raise the penalty, making use of an estimated assessment for employees' tax so that they can then calculate their penalty accordingly. So that does, I think, yeah, it could well create some practical problems for people who are in arrears with their EMP 501 returns and the employees' tax returns. Provisional tax, just a bit of practical relief that if you've got a year of assessment 6 months or shorter, that can be because a person's died perhaps, or maybe they've ceased to be a resident, or the company was incorporated part of the way through the year. If a period of assessment 6 months or shorter, then you would not be required to make a first provisional tax payment. There'll only be the second provisional tax payment at the end of the year of assessment. And remember that that is not required in the year that the taxpayer dies. Then they are busy reviewing the advanced tax ruling system, and so they're saying that there might be some legislative amendments to give effect to any problems that come through the consultation process. And they also want to review the voluntary disclosure program. So there's again a recent case, the Medtronic case, where the taxpayer basically had entered into a VDP agreement with SARS, and then the taxpayer wanted to challenge the amount of interest that had been charged on the value-added tax liability. Initially, SARS said, well, you can't challenge the interest because you've now agreed under the voluntary disclosure agreement that overrides everything else. You can't go back and ask for the interest to be waived. But this then went through to the courts, and they have handed down a judgment that says, in fact, that SARS should go back and look at waiving the interest. Now, whether this is coming through from that judgment has not been clarified, but one would think that reading between the lines, it might well have been influenced by that judgment. But all that they've said is that they want to review the voluntary disclosure provisions in the Tax Administration Act, Chapter 16 of the Tax Administration Act, to align with SARS strategic objectives and policy objectives of the program. So it's kind of a little bit fuzzy as to exactly what they're planning on doing there, but they have said that they're going to be reviewing the voluntary disclosure program as it stands in the Tax Administration Act at the moment. Okay, and that's really all of the amendments that have been proposed in the budget speech. I don't see any other questions in the chat box. Let me just see. As I did that, I lost my screen. Okay, so there is a question here. The proposal to reduce company tax from 28% to 27% raises an interesting thought on the valuation of deferred tax assets and liabilities. Yeah, this is always an issue with the deferred tax assets whenever the company tax rate changes. Maybe continuing to use 28% for deferred tax liabilities would be okay, but would this also be true? Well, look, there's nothing you need to do right now, because this is only an amendment that's going to come into effect from year of assessments commencing on or after 1 April 2022, and it hasn't been promulgated yet. So there's no adjustment that has to be done just now, but it is something that you may have to think about in the future. Okay, so yeah, thanks very much, everybody. If you do have any other questions, you have a limited amount of time to pop your questions into the box. I'm not seeing anything else coming through, so I'm just going to then say thank you very much for joining us today. Thank you for being here. I hope that this has been informative for you. And yeah, I'm going to hand back to Stan. Thank you, Stan.
So thank you, Jackie. As usual, very exciting to listen to you. And yeah, all the bad news. One day, I suppose we'll get some really good news, but we live in hope.
Yeah.
We'll see you back here in May, on 26th of May. We're going to have a mid-year
Yes.
update. So anything can happen between now and May. Just on the program for future CPD seminars and webinars and Zoom, I don't know what's going to happen with the opening of events and so on, but we're assuming that we will be still doing Zoom this month and next month at least. We do have Edwin Selps talking on ethics in a couple of weeks' time. That's on the 17th of March. It's interesting that with the corruption trial going on here and ethics coming up, that yesterday or today, the French government jailed Sarkozy, the ex-former president, for corruption. So maybe the country will take a hint from that. But we look forward to the rest of the year. There's a program. Notice for the next meetings will be going out. If you've paid your dues for this webinar, this Zoominar, your certificate will be on its way in the next day or so. And if not, pay and we'll still send it to you. And we look forward to seeing you back, Jackie. And we look forward to the next seminars. It's always good. And we learn a lot. So thank you very much.
Thank you. Thanks
Everyone,
very much.
have a good week.
All the best.
I see there might be one more question. No?
It's just
Maria says
saying,
it was a great update. Maria always,
well, thank you very much. Thanks for that.
Maria
Yeah.
always complimentary. She's great.
That's lovely. Thank you so much. All the best, everyone.